morning, friends, and welcome to the budget session for discussing provisions of the Finance Bill 2023. The Union budget has 2023 has been presented in the backdrop of a volatile geopolitical and economic environment. However, the budget seems to have done a good balancing act, staying course to meet the target of targeted cut down of fiscal deficit. At the same time, uh, focusing on increased capital outlay to bolster growth of the economy. From direct tax perspective, however, our take is that certainty and continuity of policy decisions and also ease of compliance seems to be the center theme of the budget or the finance bill. Several significant amendments from direct tax perspective, such as new tax regime for individuals and HUF, new manufacturing cooperatives new tax scheme for new manufacturing cooperatives, amendment to provisions related to taxation of startups, significant amendments, and angel tax for non-residents. So and so on. And taxation of distribution by business trusts. So we have distinguished speakers on the panel. Mr. Ajay Vora, Senior Advocate, who is the ACE litigator, tax litigator, and an authority on tax laws. While partners at Vaish Associates, Rupesh, Rohit Jain, Kavita Jha, and myself shall be taking you through the important amendments proposed in the finance bill. Arun Giri, who is founder of Tax Sutra and a live wire and household name in the tax fraternity, he shall be moderating the session. So at the end, our partner Shammi Kapoor, along with his team, and also Kavita Jha, shall take up indirect tax proposals in the finance bill. So with these, I think over to Arun.
Thanks so much. Am I audible? Good morning, everyone, and let's have some energy today. Good morning. Yeah, Kavita has told me very clearly I must sound high energy.
Yesterday he was conserving all energy. So in the morning I told him, you've already conserved, so please today no conservation.
I'll concede today one thing. I may argue with Ajay ji, but I can't argue with Kavita. It's conceded. Yeah. The budget usually a week after the budget every year we usually do a lot of intellectual brainstorming around the finance bill provisions, the policy statements, which sectors will benefit, which sectors have been given a go by, which part of the country, that used to happen. Suddenly, if you used to have the railway budget followed by the union budget. The railway budget is gone now for the last several years. So a lot of states which felt ignored would come up and say at 2 o'clock, no, our state has not got anything. This state has got everything, and we've been given stepmotherly treatment. All of that is gone. But this is the first time, at least since I have been following the budget over the last 20 years, that 72 hours after the budget, it's not the main show. The main show is something else. It's the biggest corporate governance crisis in the last decade or two, and the budget has become a bit of a sideshow, and that says a lot. I read this morning an article in the Financial Times. Now, when Financial Times 72 hours after the budget is devoting 2,000 words to one of the large industrial groups and has nothing to say about the budget in general, it means that the budget has in some ways been overshadowed this time by the events in and around it. But such events happened once or twice in our lifetime. We are not here to discuss that. We are here to discuss, however, the budget itself, but I thought I should mention it because it also reflects when we talk about tax, when we talk about foreign investors, when we talk about tax certainty, which is something that Ajay ji and Kavita and Rohit and Neeraj like a lot. No, they like uncertainty, sorry. But when we talk about investors and foreign investors and tax certainty, foreign investors also like certainty on the regulatory front. They also like a lot more best governance practices, a high benchmark on best governance practices rather than opacity. And this is something that if we as a nation, because a lot has been said, this is an Amrit Kal budget. Honestly, till 2 days back, I did not know what was Amrit Kal. I asked someone in Mumbai, ki Amrit Kal kya hai? So he said, no, we finished 75 years of independence, so 75 to 100 is supposed to be the Amrit Kal. So the next 25 years is Amrit Kal, and all of us are going to prosper, hopefully. But be that as it may, let's focus on the budget. The budget is supposed to be an annual statement of income and expenditure. But if we look at the last 4 to 5 years, it's become more of a policy statement and intent. It's become a statement of intent by the government saying that, okay, we are going to achieve a $5 trillion economy, we are going to crack down on black money, we are going to incentivize manufacturing, we are going to incentivize electric vehicles, we are going to incentivize renewables. It's become a big policy statement, a statement of intent, because you need investment in several billion dollars, hundreds of billions of dollars actually is not enough. And this budget has been also on the backdrop, not just of the macroeconomic headwinds of COVID, which hopefully is past us, and the Russia-Ukraine war, but it also is on the backdrop of China opening up. So if you heard from people who came back from Davos, where the World Economic Forum took place 15 days back, everyone is telling that the only point of discussion was China. China is back, and back with a bang. They've opened up completely. They had a zero COVID policy. That is something that Indian finance minister has not spoken about, but whoever I have been speaking to, either in the corporate world or in my journalistic fraternity, everyone is saying that if a global private equity investor is now coming, the first thing they're mentioning is China has opened up once again completely. Let's be mindful of that, because I'm sure that some of the policy statements that the government is making, the big noise, is to also counter a competitor who happens to be our neighbor. On the tax front, we have 122 amendments, but we are told that substantive is only 60. So in that sense, 3 hours should be enough for us to go through them, and for Ajay ji to bring his all his nuanced reading of the finance bill to the table. I would want to highlight, before asking a few preliminary questions or to hear Ajay ji's opening remarks, how many here have read the economic policy this year? At least some 20 pages. I read only 20 pages, that's why I'm asking. One gentleman there. Anyone else who's read the economic policy document? No? Okay, if not, at least for those who are here, Tax Sutra has prepared a nice analysis. I'll ensure that Neeraj ji sends it to everyone. It's very, very important that all of us read the economic policy document. Anyone who had read the document 24 hours before the budget, which is when it is released, could have predicted that there is going to be an incentive for the middle class taxpayers. The tax part of the economic policy document threw a lot of light and emphasized the tax buoyancy. And you look at the figures, 5 years back, 10 years back, the sort of tax collections we had. I'll give you just one statistic here. 5 years back, the total direct tax collection was in the region of 7 lakh crore. The corporate tax collection this year itself is estimated to cross that. Similarly, on the indirect tax front, and the buoyancy of the MSME contribution to the GST is, as per the economic policy document, even higher than the pre-COVID level. So the tax buoyancy is clearly reflected in some of the amendments and the relief to the middle class. Whether it's enough is another question, but if the tax base grows the way it is growing, and the economic policy document does highlight that the tax to GDP ratio, which is the ratio everyone looks at. Every finance minister in the last 20 years is saying that we need to plug down on tax evasion, we need to bring more people in the tax fold and so on and so forth. But finally we seem to be moving in the right direction. The economic policy credits faceless digitalization, it credits technology drive, crackdown on tax evaders, and GST, and integration of income tax and GST as contributing factors towards this tax buoyancy. More the tax buoyancy, better for all of us. Trust me, Ajay ji is very, very happy with the budget, and was, yeah, mainly because the super rich tax has come down from 42 to 39%. So you can see the smile, the unmistakable smile. So he's no longer worried whether I'm in the old regime, new regime, whichever regime. The super rich tax is down from 42 to 39. I am sure with the tax buoyancy, if all of you contribute a little more, that will come down to 35%. Ajay ji, with those with those preliminary remarks, my first question to you: 10 years of the Modi government, they said a non-adversarial tax regime, tax terrorism will be gone. They said more predictability and tax certainty, no retrospective amendments. They've also cracked down on tax evasion, black money. In some ways, HNIs have been more on the radar. Reduce the corporate tax rate. The highest slab of income tax has gone to 15 lakh now under the new regime. So all in all, 10 years of this government, 10 budgets down the line, do you think they have kept the promises they made?
I think, Arun, I would give them, I would give them good marks on what they promised and what they've delivered. I think these are all the positives that you've highlighted, and you all. No, this is fine. This is fine. This is all the positives that you've highlighted. I think, as a nation, what I feel is, while the tax buoyancy is increasing year on year, the number of taxpayers is not increasing the way it should increase. I think there is substantial wealth within the country, and people should, according to me, pay their right taxes so that the buoyancy grows. Equally, the government has been very proactive in making policy statements, making necessary clarifications, and I would credit and compliment CBDT on coming out with so many instructions. In fact, you flash a problem to them, you will have a circular or an instruction the next day, directing the field officers to act in a particular manner. But what is lacking, and what I would want to lament, is the gap between the policy statement and the implementation. There is no tax terrorism, as you said. This was one of the promise. There are no retrospective amendments. But I think the way the law is administered is what leaves, a lump in the throat, that you face so much unproductive litigation today. And I'm sure almost all the people here represent, corporates who are facing the brunt of litigation. And today, with the litigation the way it is going, it may take about 35 years for a matter to settle at the Supreme Court level. So you can imagine how much time, energy, cost is spent in litigating and reaching a final conclusion in the matter. It may be good for practitioners, but ultimately I don't think it sends out a good signal as a nation. So that tax certainty must come by trying to ramp up the system, the judicial delivery system, so that we have early resolution of the disputes.
Continuity and consistency seems to be the mantra in terms of tax policy. When you look at the amendments, nothing to spook the investors, corporates. You're happy?
No, I think you refer to China, and you refer to China coming back with a bang. I think one amendment in this budget is going to set you back almost a decade, and that is this 5627B amendment, which says that money is brought in at a premium above the fair value will be taxable in the hands of the company. Last night after our budget meeting, I was at a dinner with all these tech startups, and they were not aware. And they said, if this is the position, we will lose all the investment that is coming in. We are tom-tomming, we are the third largest startup ecosystem in the world. He says, we will take a substantial beating. All of them ganged up and said, you must bring it to the notice of the finance secretary, the finance minister. This one amendment will set you back.
In terms of startup, what many people, we were also a registered startup under the DPIIT. The reason we registered, and I personally spent 4 hours on that registration form online. All of you all should, in case you are eligible. But we are no longer. We've crossed the 10-year window at Tax Sutra. We are now 12 years. But I must say that what the startup ecosystem has done, anyone who has surplus money, you know, a lot of people in the corporate world, CFOs, even tax heads, tax head of a global MNC told me 6 months back that I want to invest in 5-10 startups. So it's not just the venture capital firms and the private equity firms which are investing. I know of senior advocates who are investing. I don't know whether Ajay ji is, but I know of senior advocates in Delhi who are investing in startups.
Right.
A lot of them have family offices. So what the government really needs to do, if you want to unleash the animal spirits within the economy and India Inc., you really need to have policies, tax policies that if not boost the sentiment, at least they don't cast a negative sentiment.
See what the challenge is. There is money coming into the country. You should welcome it.
Yeah.
If you have any doubt about the sources of the money, trace it and tax it. But you can't make this blanket rule that any money coming from a non-resident above the threshold of the fair value must be taxed as income of the company.
Yeah.
I think it's a retrograde step in my understanding.
Ajay ji, capital gains, a lot of people were expecting some rationalization will happen. I made a bit of a bold prediction 2 hours before the budget that nothing of that sort will happen a year before the elections. You can't hurt the capital market sentiment. Many believe a rationalization of the capital gains regime is overdue, too complicated. I'll give you one example. Out of some, we launched a new platform last year and we invited a lot of queries from readers. Out of the 50 queries that we received, some 40 were on capital gains. I couldn't believe that this regime is so complicated and is leading to such vexatious litigation. So Ajay ji, I'm sure that you believe that rationalization is overdue. Has it just become too complicated, the capital gains regime?
Complication is good for us as practitioners, but having said that, I think you can, as you said, you can have rules to simplify the number of provisions dealing with taxation of capital gains. For one, you must stay invested for 24 months, for another 12 months, for another 36 months, and the rates will differ. So I think, like you said, that rationalization is due. You can lump different instruments, different securities into one basket and make a standard rule. Yeah.
The biggest highlight, you'll agree, is on the personal tax front. We've come a long way. When I started my career at CNBC in 2004 as a reporter, the highest tax rate, I forget, I didn't fall within that bracket at all, but would have been, I'd say, 4 or 5 lakhs. 5 lakhs would have been the 30% bracket if my memory serves me back 20 years back.
Right.
Now from 5 to 15 lakh, while ATC may not be inflation linked, so many of the other deductions may not be inflation linked, but at least the slabs in the new regime from 5 to 15 lakh, I think we made decent progress. And I'm saying because it puts a lot more income in the hands of the middle class, a lot more disposable income.
I agree with you, but I think if you look at today's inflationary trends, if you look at income levels, there can be scope for increasing the 15 to maybe 20 and reducing the highest rate. The 30% at 15 lakhs, I think, is fairly high. That's what I think that 30% is high. World over, you may say that the maximum tax rate can go up to 50% in developed economies like the UK and the US, but for a growing economy like India, this will be an incentive to people to come and correctly report their taxable income. Maybe if you lower it a little below 30.
At one point which everyone here will be interested, there has been a continued focus in the last 4-5 years, this budget is no exception, on anti-avoidance provisions. So even this budget has quite a few anti-avoidance provisions. We refer to one of them, 5627B, which will now be applicable to non-residents. There are others as well. Any take on that, Ajay ji?
No, I think the provisions that you seek to bring in, according to me, can also hurt some innocent bystanders. So if you have some black sheep You have all the mechanism to trace the black sheep. I don't think you need a law to tackle the issue, in the process of which, many genuine and bona fide taxpayers also get hurt. For instance, charitable trusts. I see no reason why you can't sift the genuine from the bogus, and you make a law saying that, all charities will today become taxable, or this species of income will become taxable. I think as a administration, we are failing in that respect by bringing in law to deal with a malice rather than being able to investigate and sift out the genuine from the non-genuine.
All in all, Ajay ji, final opening remark or closing opening remark. Uh, on balance, a budget which you think checks most boxes, as against we coming and literally going after some of the provisions as we've done in the last few years, and I've been with you here. This budget, at least, we've been a little softer than usual.
Depends on what perspective you look at. You have a prism of a layman. A layman will feel that there is saving by reduction of the tax rate, by making available this optional scheme of switching between the new regime and the old regime, leaves more money in the pocket. He would be happy. If you look at it from a corporate, the corporate says not much changes. But there are some who may be impacted, and I'll specifically mention two specific provisions that we will deliberate in greater detail in the course of this session, which, according to me, can set back all that we are seeking to do, at least on the corporate front. One, we talked of 56(2)(7)(b). The second is this amendment in 28(4), which says that if there is any benefit or perquisite in cash or partly in cash, partly in kind, that will become taxable in the hands of the person receiving the benefit. I see for myself substantial litigation now spawning on this particular issue, but what I am seeking to point out, you see, you are on one side, you brought in the IBC to rehabilitate, revive companies. And there is substantial haircut taken by banks, financial institutions, if you seek to revive a company, and with a larger public interest of, saving jobs, keeping the company going. Now, if that waiver has to become taxable, I would think many promoters today would hold their hands in making a bid for a company which has gone before the NCLT in IBC. And that will put a dampener on all that you are seeking to do to revive companies. Similarly, people going in for, debt restructuring or going in with banks for restructuring of loans and so on and so forth. If this has to become taxable, then in that situation, you are seeking to drain a substantial part of the benefit that they get, which is notional, which is not really coming in cash. And to that, in that respect, I think we will be taking at least two steps backwards in the hope that we had of reviving the businesses.
Knowing the government's intent in making the IBC work, which is why they've tried to plug all loopholes, bend backwards to ensure that that IBC, the companies which are going for IBC, or where the creditors have filed CIRP applications, get a fast track resolution. So much so that the NCLT has become IBC tribunal, and which has affected Companies Act cases which are languishing now ever since the IBC law was brought in. So, knowing the government's liking for IBC, or that desire to make this work in a big way, hopefully they will hear what Ajay ji is saying. On that note, I hand it over to Neeraj. Always a pleasure to interact with Ajay ji. His contribution to the development of tax jurisprudence in this country is something that we all admire. Once again, a big hand for him, please. And we'll be hearing from him over the next couple of years. Neeraj ji, Rohit, Kavita, over to you all.
Thank you, Arun. So we start with the provisions of the finance bill. So, coming to the rates, rates of income tax. Practically there is no change in the tax rates so far as the old regime of taxation is concerned. So for any assessee, whether it is normal, special or surcharge or education cess. For assessment year 2024-25, again there is no change in the tax rates for the old regime. People opting or getting taxed under the old regime. All the changes in the tax rate which are provided or are proposed are in relation to, in respect of a new regime of taxation which is 115 BAC. So there is no change in the tax rate for under old regime, only in the new regime. Then companies, no change in the tax rates. For cooperative societies, new manufacturing cooperative societies, there is a change proposed in terms of a new tax regime in the line of 115 BAA, that is 115 BAE. So the income of these cooperative societies would be taxed at the rate of 15% in terms of the new regime, this new regime. So section 115 BAC, the new regime for taxation of individual and HUF. This was brought in by the Finance Act 2020, and which provided at that time when it was brought in an option to the individual and HUF to pay tax at a concessional rate as per the slab which was provided therein. The slab rates, there is only one slab rate irrespective of age, etc. And for claiming this these concessional rates, you have to forego various deductions in chapter 6 and things like that. Now at that point in time, this regime of concessional rate was there was an option, and this was not a default tax regime. Now with this budget for all individual and HUF, this in a significant change, I would call it, the concessional regime or the new tax regime has been made as a default setting. So each individual and HUF would by default would be taxed under this regime, under section 115 BAC, unless he opts out, and there are, for opting out there are conditions and provided, and there are certain conditionalities and restrictions provided, and so as to go back to the old taxation regime. So one, it is a default tax regime. Secondly, slab rate, we have just made a comparative of the changes in the slab rate. So that is for you to see. In the old regime, these are the rates, and these were the rates which were there previously. There is no change. In the new regime, on assessment year 23-24, these rates and slab starts at 2,50,000 rupees. So first 2,50,000 no tax. Then 2,50,000 to 5,000, 5%, 10% thereafter. Then 15% from 7,50,000 to 10 lakhs, and 10 lakhs to 12,50,000, 20%, and 12,50,000 to 15 lakhs, it is 25%, and above 50 lakhs, it was 30%. Now going forward for assessment year 2024-25 onwards, this minimum threshold of 2,50,000 has been increased to 3 lakhs. Then 3 lakh to 6 lakhs, it is 5%. 6 lakhs to 9 lakhs, 10%. And 9 lakhs to 12 lakhs, 15%. Then 12 lakh to 15 lakhs, 20%. So, and beyond 15 lakhs, it is 30%. So there is some concession in tax rates given in the new regime from assessment year 2045 onwards. Now, in the new regime, if one were to be opting out, as I said, it is made as a default setting, and it is a default, by default you would be liable to pay tax as per the new regime. The person having business income would have to can opt out before or on the due date of filing the return under section 139(1). Option once exercised, for persons having business income, option once exercised to go back to the old scheme or the new scheme, it will continue for the subsequent year. So option to opt back for persons having business income, individual or HUF having business income, option to go back to the old scheme, from old scheme to new scheme, can be exercised only once. So if you remain on old scheme, once in a lifetime you can go back to or opt back to the old scheme, to the new scheme. For persons not having business income, they have to opt on or before the due date of filing return of income. Then every year they would have option to opt in, choose or opt from old regime or the new regime every year. So for a person not having business income, the option is available every year. Now surcharge, as we were discussing, there is a major relief which has been provided to high income individuals having income exceeding 5 crores. The surcharge, which was earlier 37%, has been restricted to maximum of 25%. So that would consequently, for the highest slab, the tax rate would go down from 42.744% to 39%. And certain deductions under section 115B, when you opt for the new regime, certain deductions which were not earlier available has now been made available even under the new regime. So which is a standard deduction under section 16(1)(a). Then there are other two deductions which would be now available under 115. Now there was much talk that for up to income up to 7 lakhs there is no tax. So which is coming by way of or from the rebate which is provided under section 87A. So 87A previously there was a rebate of 12,500 provided for income persons or individuals having income up to 5 lakhs. So up to, if the income is up to 5 lakhs, by virtue of this rebate they may end up paying no tax. Now this has been increased to 5 lakhs has been increased to 7 lakhs. So consequently a rebate of up to 25,000 is available. So in persons having income up to 7 lakhs would escape taxation altogether under the new regime. Now no, it will be 1/4/24 would mean assessment year starting from assessment year 2024-25. So if we look at couple of illustrations to understand how this tax regime is operating, or what is the effect, overall effect of the same. So if under the old regime, if the income, gross total income is 7 lakhs, under the old regime, the individual, after claiming rebate of 12,500, he'll end up paying tax of 10,000 rupees. And while he's claiming even deduction under section 80C of 1,50,000. And on the other hand, in the new regime, he'll escape taxation altogether. So he'll not claim deduction under section 80C, and he'll he'll avail rebate under Section 87A of 25,000. In the second scenario, where individual also claims say benefit or exemption under for HRA. So let's see how it operates. So income under the head salary 20 lakhs. In the old scheme he is claiming the benefit or HRA of 3,60,000 as not taxable. 10,000 of LTA is also not claimed as not taxable. And then he claims a standard deduction of 50,000 and so on. So his tax liability would work out to 2,40,240. On the same income of 20 lakhs, if he is to be foregoing or opting for the new regime and thereby foregoing this exemption on HRA and LTA and few other deductions, ATC, ATD, etc., etc., then his tax incidence or tax liability would work out to 3,04,200. So for a higher income group having HRA claiming a significant amount of exemption in respect of HRA, etc., maybe the new regime may not work, or it may not be beneficial. And if there is no exemption being claimed in HRA, and if we were to be comparing old regime and new regime, so in old regime there would be higher tax incidence for the same income of 20 lakhs. The tax in the old regime would be 3,52,560, and in the new regime it will be 3,04,200. So new regime in any case would be beneficial if the benefit of HRA or HRA is not exemption of HRA is not being claimed by the individual. Then for high income group individuals having income beyond 5 crores, let's see how it operates. If income is say 10 crores and he claims HRA of 1 crore 50 lakhs, and he claims a few other deductions, ATC, ATD, etc., his tax liability would work out to 3 crore 61 lakhs 67,000. And in this case also, and in new regime, this tax liability after foregoing this HRA exemption and deductions, this would be slightly higher of 3 crore 87 lakh 85,500. So same result, if there is a sizable amount of HRA exemption to be claimed and few other deductions, then maybe old regime would work better for the individual. And if without HRA, in any case, again the new regime would work better for that high income individual, as we are seeing in the last two columns. So this is the tax position so far as tax rate is concerned. It is 50,000 only. This maximum is 50,000.
I think Neeraj ji, what he is asking is, does the standard deduction kick in only after 15 lakh? Okay.
Achha, okay. No, this is we have given by way of an example. I'll check.
Yeah. But Neeraj ji, this is very, very insightful. So essentially, if our reading is right, HRA is the big difference. So one has to see the HRA.
That is the key.
Very insightful.
Key differentiator, I would say. Key differentiator.
How many here have HRA? How many are claiming HRA? अरे हाथ ऊपर करो यार, income tax के पास नहीं जाएंगे. And this is quite significant. Yeah.
No, but still I think the question that will come in is, you are better off in the old regime or the new regime. You will have to do that maths every year. So that option is available. So depending on which it leaves you with a lesser tax incidence, I think one can opt depending on that.
Yeah.
And then this maths can only be done by people not having business income. No, no. If he has business income, so he has opted for old scheme. So he would have to be continuing, and he has option to come back to the new regime once. So he can in any case come back to the new regime. And when he comes back to the new regime and he does not have,
Point is, I think, very nuanced. He is saying he is come back to the new regime, he has taken that option.
correct.
Now, thereafter, he wants to switch every year.
Then that he can do possibly because
I
he
think,
never had.
Arun, I don't know if you notice, in a seminar of Vaish Associates, you will have these very nuanced people who have read the budget with a tooth comb and will come up with very micro issues, unlike what you do at a top level discussion. So I think Mr. Sehgal has thought through his whole situation and he therefore wants to understand today.
So far as my understanding goes, he has in any case one option to come back, and when he comes back to the new regime, and he does not have business income thereafter, then he would have option to go back to back and forth. That is what I'm trying to say. So because when he comes back to the new regime and he does not have any other business income since that point in time, then he would have option to go back.
So
Yeah,
once
he
he
is
has
starting
made
at
that
ground
switch, he is
zero.
starting
Yes,
at ground
he is
zero.
starting at
Yes.
So you will actually you will start falling in a new regime, in the different category, which individuals which have no business income, who have option to switch on, switch off, depending upon your choice.
So आपका पीछे का माफ कर दिया ये मान लीजिए.
Can I put one question to Ajay ji
Yeah,
on this?
yeah.
A quick one. Ajay ji, it's very clear. The interviews of the finance secretary, revenue secretary, that they want people to opt for the new regime. I read somewhere only 500,000 taxpayers have opted for the new regime. The number may be wrong, but that's barely 1% or 2%. So they want a lot more people to opt for the new regime. Now the question is, Ajay ji, while doing so, you still are giving the option of an older regime. So people will always look for arbitrage, people will always look for opportunities. So what exactly is the government trying to achieve here?
No, I think the government is giving you this bait of reduced tax under the new regime, and at the same time wanting to reduce their administrative time in processing returns.
In
You
processing
see,
return,
if it's
in
a simple
litigation,
return, I think mathematically the computer will process the return in no time.
and it,
There are no claims, no exemption that you've claimed, no deductions you've claimed. So that would make it so much more easier for them. I think only from that angle, simplicity.
and as the joint secretary was stating, that it may even reduce litigation and things like that. They would have to be doing lesser verification, and then it would also not throw up as many litigation or disputes.
Example, yesterday, we were at, Arun and I were at a seminar yesterday, where he said that, we will then not have to bother about an HRS scam in Chennai or another scam somewhere else. So this way the computer will just pick up the return and process the returns. So it'll make it simple for everyone concerned.
Maybe if the arbitrage is gone, we'll not have to pay rent to our fathers or mothers and claim the HRA. But jokes apart, Neeraj ji, this is definitely one of the big highlights of the budget. You want to take a question or two in case anyone has? In case? Or we'll take at the end? You have one question there, we'll take that.
Eventually, I mean, they fall back on their children in their old age. And especially this generation which is coming, in any case, they're into consumption. So one small incentive which was there to save, to invest, that's been taken away. Would it not have an adverse impact?
Very well put. Just to build on that, somewhere the government is clearly saying that tax should not be the reason why you invest. So they want to take away that mindset. If you want to invest, invest, but not because of tax. Ajay.
I think the government gave was that you normally tend to take the benefit up to a slab of 15 lakhs. So their analysis was that most of the people who fall in that category actually they won't be able to invest 2.5 or 3 lakhs rupees in order to get the benefit, because that actually results in a cash outflow.
But what sir is saying is very fair. What he's trying to say is that this is going to be a disincentive
Correct.
for investors.
Correct.
No, I think basically from what the government came out saying was, we are not seeking to mandate your choice of an investment. You can still make the investment, but you don't have to necessarily put it in an ATC specified instrument, or you don't have to necessarily take out an LIC policy. That's your choice. You can still make, if you have that funds available, you can still make an investment to, cover your rainy day. But why put it only in something which gives you a tax advantage? So assume that under the new regime your tax is lower than your tax payable under the old regime after taking all those incentives. So you will be left with the money that you would ordinarily have put in that investment plus the tax that you would save. So that's your choice to make that investment. No, tax break they are seeking to offset by the lower tax. So, yeah.
But point is very well taken. This will definitely have an impact on investment, which is why the stocks of some of the leading insurance companies have fallen. Yeah.
It is not just numbers, and therefore, and especially in tech employees or any other employees, at the beginning of their careers, this kind of an incentive will certainly drive them to think for taking a policy.
Yeah.
So government, in fact, maybe thinks differently. They are proceeding on the basis that the citizens are mature enough to make right decisions, and why to tie them up only to the prescribed
We'll wind
investments.
up this point on a lighter note, that you have so many financial influencers on YouTube now. One of my good friends is actually one of the leading influencers, Rachana Ranade. I must tell you that a lot of youngsters now are into investing in stock market at the age of 17 and 18. It's just stunning. My best friend, who happens to be the head of operations of one of the largest brokerages in this country, told me that the sort of demat account openings that's happened in the last 3 years is just incredible and mind-boggling. So students are now, looking at YouTube channels, they are looking at influencers, and then they are all into stock market investing since college days. That
All
was
kind of ideas, all kind of possibilities are there. People are making huge money here on various.
Yeah.
I think Mr. Mehta.
Yep.
Right.
Well said, sir. Well said.
So I think one point that Arun we can mention before we go on to the next topic is, even if a person has made a declaration to the employer for purposes of TDS at the beginning of the year that he'll opt for A regime or B regime, the return can be filed on a different basis. I think it doesn't tie down the individual to necessarily file the return on the basis of the declaration given to the employer at the beginning of the year. I think.
So, two small amendments on personal taxation front. One is for valuation of perquisite of rent-free accommodation and accommodation provided on concessional rent. So there were different bases of valuation at present under the Act for these two items of perquisite. For rent-free accommodation, Rule 3 provided the valuation methodology or basis of valuation, while for rent concessional accommodation provided on concessional rent, explanation 1 to 4 of section 17 subsection 2 provided the mechanics. Now they are sought to be made uniform. It is there is going to be one valuation rule for both item of perquisite, for taxation of both item of perquisite. Secondly, for income sums received from life insurance policy in respect of ULIP, etc. Earlier income received in respect of policy where premium is paid exceeds 2,50,000 were not liable to eligible for exemption. They are taxable. And now another provision is sought to be incorporated, where other than ULIP policies where premium exceeds 5 lakhs, the amount received in respect of such policies would not be exempt. Coming to one of the key
5 lakh rupees. So what will be the treatment in that case? This will be aggregate will be taken or for individual policy?
It says in the policy, the letter of the law says premium or aggregate premium payable during the term of one such policy, one or more such policies.
Just one point here. I heard the Revenue Secretary or the Finance Secretary on CNBC. At least they seem to suggest that this is the example the Revenue Secretary or the Finance Secretary gave. That if you have one policy of 4 lakh and another policy of 2 lakh, then you're fine. So the problem is if you have, say, one policy of 7 lakh, but if that is split into two policies, then you're fine, is what they seem to indicate. But there still seems to be an area of concern.
But section says amount of premium or aggregate premium paid during the tenure for one or more such policies. So it can what is to be seen is the aggregate premium which is paid. Then coming to this much talked about amendment related to non-resident as we all know, under section 5 of the Income Tax Act, total income or global income of a resident is taxable. And in case of resident but not ordinarily resident, any income which accrues or arrives to him outside India is not included in his taxable income unless it is derived from a business controlled or profession set up in India. So this is the tax net so far as resident but not ordinary resident is concerned. Now section 56 to 10, as you know, provides that where a person receives an amount exceeding rupees 50,000 without consideration, then such amount is shall be taxable as income from other sources. Now this there was a provision clause 8 of section 9(1) in fact provides that any non-resident, if any non-resident receives an amount exceeding 50,000 which is taxable as per section 56 to 10, so that will also be taxable or deemed to be income accruing and arising in the hands of the non-resident. So such income exceeding 50,000 rupees would which has been made taxable in the hands of non-residents by virtue of clause 8 of section 9(1) of the Income Tax Act. Now there was no such similar provision for resident but not ordinarily resident. So consequently, by going by the language of the section, any amount which is received by resident but not ordinarily resident exceeding rupees 50,000 would escape taxation. So in order to plug this gap and or money which may be gifted exceeding 50,000 to resident but not ordinarily resident, This amendment has been proposed, and whereby on or after 1/4/2023, a person, if a person receives or a resident but not ordinary resident in India receives an income or an amount exceeding 50,000 rupees, that would become taxable in his hand.
One question to you, why do you call it a gap? Actually, according to me, this is a deeming fiction brought in to get over the normal principle that a capital receipt is not liable to tax. A gift is normally a capital receipt. By a deeming fiction, you are seeking to bring it to tax. Now, when you tax a non-resident under section 56(2)(10), you are overriding the charging provision of section 4 and 5, which says a non-resident is liable to tax only with respect to income sourced from India. So, if there is a gift given to a non-resident or a person, a resident but not ordinary resident, you are giving a go-by to that principle. And the second question will be that, assuming the resident, non-resident or the person not ordinary resident is resident of a treaty country, so whether you can say that the treaty will override section 56(2)(10), those will be questions that will arise in the context of the department seeking to levy tax on these kind of gifts.
So that's right. Maybe there is no corresponding in terms of section 4 whether a gift would constitute income or not, would not constitute. Yeah, correct.
So
Specific provision not in the in section 9 making it taxable or as taxable as an income accruing or arising, then in the hands of that would be the issue.
Do a treaty override, sir?
That exists.
Mr. Voda, will the issue of right shares or bonus shares hit the non-resident under this new amendment?
Only for a sum of money. If you recall the finance bill, I think maybe 21, the bill sought to tax receipt of property by a non-resident, and they made it as wide as 56(2)(10) in its applicability to residents. But when the act was passed, they restricted it only to a sum of money. So mercifully, today it is only sum of money that is paid to a non-resident or a person not ordinary resident. It will not apply to right shares or bonus shares.
Thank you.
So I have a small question. Like, what would be the implication of TDS in such cases?
No, it's in case of for there is which provision of TDS would apply?
See, if you are making a payment to a non-resident, he is referring to section 195, no?
No, that is for non-resident. Here the amendment is of we are talking about is resident but not ordinary resident, no?
He will still be taxed as a non-resident only.
No, if it is non-resident, it is taxed as non-resident, then it will be section 195 would have come into play.
No,
And then if it is income chargeable to tax in India, then tax withholding would be required. But to my mind, section 195, because for non-resident, similar taxation provision was already there in the statute. Now there is another provision being brought in to.
So you are right. So this applies. 195 applies only to a non-resident, not to an RNOR.
Correct. So this is a separate provision brought in for taxation of such income for resident but not ordinary resident. There is no provision, I think, TDS provision which would apply. The only respite that one would have is that if that resident but not ordinary resident happens to be a resident of a foreign country in terms of the treaty provisions, then he may have recourse to the treaty, and in treaties there would not be any specific provision dealing with taxation of this kind of gift or such item of income. So it will naturally go to the residuary article of the treaty. So whether, say for instance, in case of treaty with UAE, So this is Article 22, which says that any income which are not expressly dealt with other articles, the tax treaty shall be of the tax treaties, it shall be taxable only in the state of residence of the income of the residents. So if he is resident in terms of the treaty of any country, or say for instance in this case of UAE, so he would escape taxation in India even despite this provision by virtue of the of Article 22 of the treaty. So he would then say that he is taxable in UAE, and in UAE he may not end up paying any tax. So now coming to taxation of so any other question on this from
We'll
Mr.
move ahead.
or
We'll-
Mr. Wo-
We'll move ahead.
So taxation of startups. Section 79, as we all know, it provides for a restriction on set off and carry forward of losses, where there is change in the shareholding. So if at the end of the previous year in which the loss was incurred, the shareholders holding voting shares of voting rights exceeding 51%, they do not continue to be the same at the time when you are in the year in which you are seeking to set up that loss. Then that set off of loss is denied. So at the end of the previous year, when you are seeking to set off a loss of a preceding year, at least 51% of the shareholders having voting rights exceeding 51% should remain the same. Now, in respect of an eligible startup, which is referred to in section 80IC, some relaxation was provided, and it says that all shareholders having voting power on the last day of the previous year in which loss was incurred continue to hold the shares on the last day of the previous year in which income was set off. So this condition of 51% was not there, and this loss which could be set off for a startup was for 7 years, over a period of 7 years. So such loss should have been incurred within a period of 7 years. So this amendment is sought to be proposed to increase this period of 7 years to 10 years. So which is to align this period of loss with section 80IC 80IAC 2 of the Act, which is providing for the tax holiday or tax deduction to the startups, where also 10 years period is of deduction is provided. Then in 80IAC, the sunset clause was at present it was 1st April 2023. So that is being extended to 1st April 2024. It is being extended by 1 year. So these two benefits sought to be given or extended to eligible startups by in the budget provisions. Then the section itself provides where shareholders continue to remain the same. Whether inter se you are transferring shares between among the shareholders, then there is a caveat carved out. So this section 79 would not trigger.
Losses, all the shareholders having the voting power on the last day of the previous year continue to hold the share on the last day of the previous year. Does that mean that if the one shareholder go away and then the setup would not be allowed?
Yes.
Even the ones here, because that would be very difficult, because normally in the startup we see that some of the co-founder or maybe some of the shareholders go away, and then it would be a hurdle for the
Neeraj ji,
startup.
currently,
Let me
summarize,
reconnect.
currently it is 51% rule.
Yeah.
Correct.
So which means 51%
No, I understand. slide number 30.
No, not 51% of shareholders, huh?
No, no,
51% voting rights, right?
voting rights,
Not
yes.
shareholders.
Yeah, yeah.
51% voting rights. So even if one shareholder has 51%, as long as he remains with 51 and other 49, everyone exit.
Yes,
This
that,
loss.
that's why we are raising this, because it's mentioned that all the shareholders. That's not mentioning that the 51%.
The shareholders having voting power.
It only proviso says the same thing. It says if all the shareholders of such company who held shares carrying voting powers on the last day of the year or years in which loss was incurred continue to hold those shares on the last day of such previous year, and such loss has been incurred during the period of 7 years. So all the shareholders.
So it's
having
not
voting
condition
power.
of 51%.
So if you get into litigation, come back to us. As you are rightly saying, the principal condition is 51%. So this requirement of all shareholders is actually extraneous.
Correct. So proviso should be subservient and to the main section. So there is a scope for this. So as I mentioned in the beginning, there is new tax regime sought to be provided, a concessional rate of taxation for new manufacturing cooperative societies, which are registered on or after 1st April 2023, and they commence manufacturing or production activity on or before 31st March 2024. So this is there is 1 year window, and there are certain other conditions which are also provided, such as splitting up. They should not be formed by splitting up or reconstruction of business, etc., etc. So their income or business income would be subjected to tax at a concessional rate of 15%. So angel tax. 56 to 7B, as we are aware, a company not being a company in which public are substantially interested receives from any person being resident any consideration for issue of shares which exceeds fair market value, then it is liable to be subjected to tax. The excess amount is liable to tax as income from other sources under section 56 to 7B. So this provision for taxation was hitherto meant for resident. So resident shareholder subscriber to the shares, and there was huge dispute around this provision in terms of the valuation of what would be the fair market value. Fair market value was provided to mean value determined read with in terms of rule 11 UA, value determined on the basis of either net asset value or DCF method determined by the merchant banker, or as may be substantiated to the satisfaction of the income tax authorities, whichever is higher. So basically NAV or DCF. This provision in fact also provided in fact escape for startups, eligible startups, which are generally in fact registered startups were not really governed or covered by this provision. There is section 56 to 7B was not specifically provides an exemption in respect of issue of shares by these eligible startups. Now as we have seen, this provision was at present was not only applicable to resident shareholders who are subscribing to the shares of the company, and non-resident investors were not maybe consciously brought into the net of this provision or this debate of valuation of shares or determining the fair market value of shares. Now, finance bill has extended application of section 56 to 7B to non-resident investors as well. So, in the net, what is happening is that all shareholders who are subscribing to the shares, irrespective of their residential status, whether it is resident or non-resident, would have to satisfy this test of receiving shares at fair market value, which is somewhat a subjective determination based on the rule and by the merchant banker, but it is always in practice it is always disputed by the assessing officer in the assessment. So that's the only respite, and you may have seen the statement also from the government that all the registered startups, or more than 80,000 startups, would not get covered. They'll escape. So there were about 80 at the close on 1st of February 2023. There were close to 90,000 startups which were registered with DPIIT, while the actual startup which are operating or which are actually operating in India, that would be much more. So it is not only 89,759 startups. These are the only registered startups. These registered startups would certainly would continue to avail that exemption provided under section 56 to 7B, and that section would not apply to them. But rest of the startups who are not registered, they would, even if they were to be receiving shares from whether resident or from non-residents, they would have to satisfy this test of being, issuing shares or receiving shares. Shareholder would have to satisfy that they are receiving shares at fair market value. So, as a consequence, what would happen is that generally, and we all know that in the assessments, in the assessments here, every valuation of shares where assessing officer or the assessee or taxpayer may be relying upon the valuation report of an expert or a merchant banker, that gets into a dispute, even if it is done as per the prescribed rule, applying DCF or net asset or net asset value method. And on in fact, in most of the cases, in case of non-residents particularly, the valuation is also seen by or is submitted to the Reserve Bank of India under the FEMA regulation. So that valuation is to be undertaken as per applying the DCF method. So valuation rule basically is the same, method is the same method. So now the question is that once having accepted the valuation or the Reserve Bank of India having accepted the valuation at DCF, whether income tax authorities would still dispute it. So courts have in many cases have said that here and including Delhi High Court and several tribunal judgments have consistently upheld the valuation report, the valuation undertaken by the taxpayer, so long as this valuation is undertaken on a prima facie on a reasonable basis, and there is no any other objection or in relation to that. So this debate, in any case, this may give rise to dispute in all cases, and the non-resident subscriber to the shareholders to the shares of the Indian companies would have to go through this grind.
Sir, as Vora sir mentioned initially that in the meeting with some tech startup, then they were talking about where the fair market value exceeds the amount, so that would be under the coverage of 56 to 7B. So is this because they are not recognized startups? Because there's a mention that the various unorganized startups that would be applicable for that, and the exemption for the startup recognized in the DPIIT. So is that only for the unrecognized, and it is applicable for the recognized startups also?
To all unlisted companies, whether startup or not, right? For recognized startups, this exemption is available. Those recognized 80,000 startups, for them only the exemption is available if they raise capital at more than the fair market value.
Okay.
If you have passed that threshold, like he said, Tax Sutra has crossed that period, and they are today not a recognized startup. If he is to raise capital at premium, which is more than the fair market value, it will be taxable in the hands of the company.
Okay.
So this will be a dampener on capital raising ability of unlisted companies.
One small question again to this only. The certificate of 11 UA, you can opt it to take it from a chartered accountant or a merchant banker. For FEMA also, merchant banker is also allowed, and they have also the DCF method for doing that. So somehow the problem may be diluted for the purpose of non-resident FEMA valuation and income tax. But under Companies Act, there is a requirement to obtain valuation from a registered valuer, which is not a merchant banker. How to deal that? That would be a challenge going to be.
Requirement of the section is merchant banker for the purpose of section 56.
But for Companies Act,
you are right. So therefore, at least I have seen in practical experience, the same merchant banker has a separate outfit which is a registered valuer. So you have the same valuation given by two different persons, and behind the two entities is actually one and the same person. So to satisfy the income tax and the Companies Act requirement, you will possibly need to have a registered valuer and also a merchant banker. But I think the larger question that will come in this is, every valuation is going to get into dispute, as Neeraj said. I'll give you, two live cases. One is presently sub judice. The second we successfully argued before the Delhi High Court. That is reported as Sinestan Entertainment. Now that Sinestan signed a contract with Rakesh Om Prakash Mehra. I think he made the Delhi 6, his famous movie, whatever movie he made, Rang De Basanti. So they had a contract for Rakesh Om Prakash Mehra to direct, I think, 6 films. And you had Rakesh Jhunjhunwala, you had Anand Mahindra, you had all the reputed investors who put money into that company on substantial premium, which was worked out basis what they thought was the potential of that business, and that Rakesh Om Prakash Mehra would deliver a super hit. The contract got terminated somewhere in between. The films that were to be made never got made, and the tax department brought this to tax. They disregarded the DCF, saying on actual results, it is much below what was projected in the DCF valuation. So in hindsight, the results were never achieved. The tribunal said the assessing officer could not move from DCF to NAV. He could at best pick holes in the DCF valuation. So the High Court approved the tribunal judgment, and the High Court has made very illuminating observations that valuation is an art, not a science. You can't exactly predict what the value would be. When you are making the projection, you have to sit and step into the shoes of the merchant banker who is making the projection at that point of time, or on the management at that point of time. You cannot in hindsight say that, these results were not achieved, so therefore the projections were not correct. Second, they said that this is actually an anti-abuse provision, a money laundering provision. So here, if you have reputed investors who are coming in, I don't see how this can be treated as an anti-abuse situation where you need to bring this to tax. So clearly now what will happen is, and we need to step back for a moment to understand why this amendment came in. As Neeraj pointed out, Section 68 was there in the statute always to say that you could tax any credit in the hands of an assessee if the assessee is not able to satisfactorily explain A, the identity of the creditor, the genuineness of the transaction, and the creditworthiness of the subscriber or the creditor. You had the Supreme Court judgment in Lovely Capital which said that if a company has received capital from identified people then in that situation you can't tax it as income of the company under section 68. That took one extreme, and there were, in fact, almost all companies passed through that net in that situation, applying lovely capital. Then the matters came before the Delhi High Court, and there was substantial capital raised, and largely bogus capital. I'll admit, largely bogus capital, but paperwork was correct. So then the Delhi High Court said that, look, either you investigate further, or on this basis the assessee has discharged the preliminary onus of proving the three ingredients, and hence you can't tax it. And the High Court then were grappled with situations where almost a non-existent company with no business was raising capital at phenomenal premium. A 10 rupee share was being issued at 990 premium, so 1,000 rupees was brought in. And we are all aware of the Calcutta companies and how the money was routed. So faced with that situation, in one judgment the High Court said that if money is being raised at such substantial premium by a company which has actually no operations and the valuation is not justified, the amount will be taxed under section 68. Now, basis that, I think Finance Act 2016 or 17 brought in an amendment in section 68 saying that the source of capital raised by a company from a resident investor will have to be proved. So you need to prove the source of source. Only then, if you satisfactorily prove the source of source, you will escape the rigors of section 68. Simultaneously, this 56(2)(7)(b) also came in, that if the company has raised money at premium which is above the fair market value, then that premium will also be taxed in the hands of the company. And there was an exemption that was carved out for non-residents. So raising of capital from non-residents was not subject to tax, notwithstanding that the capital was infused at a premium which was more than the fair market value. Now today what this does is places the raising of capital from resident and non-residents on the same pedestal. It has to satisfy the benchmark of being raised at the fair market value. And as Neeraj pointed out, fair market value can either be the NAV as per Rule 11UA or based on a DCF. As per court judgment, the assessing officer cannot switch the method. If you've chosen DCF, he must go by the DCF valuation. But inordinately we find that the valuation is being questioned in any and every case. And I am today grappling with a live case where there is an 1100 crore demand for monies raised from its holding company. And the question is that the monies have come at a premium which is not justified with reference to the fair market value. We are trying to tell the tax department, look, if you were to raise the capital, we could have increased the number of shares, brought down the premium amount, still raised the same amount of money without any tax implications. But this is what is going to, happen in the days to come. I see this as one major litigation issue that will spawn from the proposals in the finance bill. And today, if you look at startups who have, passed through that 7-year period and are raising capital. Now, the capital that you raise and the premium that somebody pays is based on perception. Today, you are looking at a business potential and you think this idea is going to, germinate in future, it will bring in super profits, it will rake in super moolah, and on that basis a foreign investor is willing to pay substantial sums of money. You've seen how many large investors, Sequoia, Tiger Global, and Alibaba and Ant have written off investments in Indian companies over time and are still putting in money. Yeah.
So double whammy, because a lot of the companies are now in the growth stage, so they are over the 10 years, which is what the DPIT registration, that safe harbor is for 10 years from the date of incorporation. Many of them are past the 10-year stage. And second, currently, a lot of them are staring at a down round. A down round means the valuation which is lower than the last round. Right. This could be a double whammy from that point of view.
I think Mr. Mehta does valuation of companies. You look at enterprise valuation. When you raise money, you are looking at enterprise valuation maybe more than a DCF. And as a promoter, if there is an incoming party, you also charge a control premium. Your, Vikramjit is here from Radico. They look at foreign investors. What are you doing? You are saying if you want to buy into a greenfield venture, which is an up and running company, very profitable company, you need to pay me more than, what is the DCF valuation. So that kind of control premium will become taxable in the hands of the company. So what are we doing? We are looking at bringing investment into India. We are wanting, people to come into India. We are wanting to overtake China, but we are putting roadblocks in the entire process.
But 10 out of investors know that investor invest. They know that out of 10 startups, only 2 or 3 will ultimately, turn out to be successful. So they also do their mathematics like this. But for those 7 which have actually not successful, for that there will be an additional tax liability because their numbers, DCF numbers may not match with the actual numbers.
One small point. The law requires that I should do the valuation at the point on the day of the valuation, on the day of the getting the shares. So I don't know whether that has been built into the law so far, but in company law it has been built in.
11 UA.
It's there, exactly.
No, it is then, on the date that you raise.
No, therefore I'm saying, sir, looking at the future performance, at the future actual performance, is totally unjustified.
In your example, when you give the example that the company purchase the raise the money from its own holding company, right, and the department is raising the question that it's of the fair value, and you gave a counterpoint that okay, if we could have issued the larger number of the shares, but the point is that department can say that okay, it could be a strategy of the company to have the base at a created from its own internal company, so that later on it can go to the market and say that okay, this is our base. So I mean, from that point of view, if
absolutely correct, but at the moment 56 to 7B, if it's an anti-abuse provision, if it's a anti-money laundering provision, there is no intent to evade tax.
I agree, but ultimately,
no, you are right.
There could be a strategy of the company.
That's right. You are right. You don't want to bloat the capital base.
Absolutely.
I am saying I am fully with you. When companies raise capital at premium, a startup for instance,
right,
they don't want to dilute control.
Yes.
They don't want to change the cap table. They don't want to change all of that.
Absolutely.
That I fully understand. But I am saying this argument is good from a standpoint that this is not an anti-abuse measure.
This is not anti-abuse.
Yes.
Right.
Non-resident were to be, say, a related party or an associated enterprise of the company which is issuing shares, then there would be another difficulty, and there are disputes arising in a sense that if the valuation has been undertaken applying Rule 11 UA at NAV, and whether then the transfer pricing provisions come in, and transfer pricing provision would apply to these transactions, then whether NAV valuation at NAV would also satisfy arm's length test under the transfer pricing. So these all kind of issues, and this is a real life. These are difficulty, and in fact, Mr. K.S. Mehta is among us, and when we were CA students, he is the one who has authored the Institute of Opinion on Valuation, and we used to read that opinion at that point in time. And in fact, if I may take liberty to point out, there was one litigation which was going on before Company Law Board, and then which traveled up to Supreme Court, and there was a Supreme Court appointed an arbitrator, Justice Wadhwa, and Mr. K.S. Mehta was assisting the arbitrator and that purely involved a similar valuation issue, valuation of shares. In that case, since we were doing the valuation in the hindsight, say 10 years ago, and we had all the future published accounts or audited accounts of that company, so while determining the value of the shares of that particular company, applying future profitability method or whatever, we took into account the audited results, and we presented that valuation to the valuer, to the arbitrator, and Mr. Mehta was looking at that valuation, and he rejected that valuation. Mr. Vora says that courts have said that valuation is an art, not science, and he said that no, valuer has to anticipate what is the future, the forecast which valuer is standing at that point in time when the shares are to be valued. To what extent he can see, we cannot rely on the audited, also the audited accounts which are actually available now. So these are the all kind of niceties in terms of valuation arise when there is a debate. So there is we anticipate that there is going to be huge litigation which non-residents have to go through by virtue of this amendment.
Yeah, so we'll have to, so right now, just 1 second.
One request to you especially, sir, you are an influencer. You should take this up. What is the benefit we get by bringing in this provision for capping 10% of the people? You are hurting 90% of the genuine investors.
And you have all the resources to investigate. You see, if you want to investigate the source of the money, like for instance, if it is round tripping, you can investigate, you can single out those people rather than making this universal amendment.
Yeah, fair point. We'll try to influence through Tax Sutra.
So coming to the next amendment, this is taxation of business trusts. So in case of REIT and in NVIT etc., which are commonly known as business trusts, there is a separate special regime of taxation which is provided under section 11 UA, and these for the purpose of taxation the business trusts are treated as a pass-through. So what happens is that section 1023 FC and section 1023 FCA, these two sections makes interest, dividend and rent etc. received by these business trusts as not taxable or exempt in the hands of the business trust. And by virtue of section 115 UA, these incomes are taxed in the hands of the unit holder. So they are in fact, if I may point out from the provision itself, so 115 UB says they shall be chargeable to income tax in the same manner as if they were the income accruing or arising or received by the person who made the investment, and in the same proportion. So the character or nature of the income, if trust is distributing income which is of the nature of interest or dividend or rent etc., character of the income would be same, and it will be taxed as such in the same proportion in the hands of the unit holder. Now what happens is that these business trusts are, apart from interest, dividend and rental income, they are also distributing or paying the unit holder by way of repayment of capital or repayment of debt. So these income per se were not getting taxed in the hands of the shareholder in the hands of the unit holder. And in fact, at the time of redemption of the of such units, there would be tax incidence the way it arises under the head capital gain or whatever. Now there is a complete change in the scheme of taxation, whereby and that is to bring to tax. So interest, dividend and rent etc. was already taxed in the hands of the unit holder. What was not being taxed in the hands of the unit holder is repayment of debt, the distribution made by way of repayment of debt and repayment of capital. Now the amendment, there is clause 12 is proposed to be inserted to section 56(2), which to bring to tax the sum received which are not in the nature of any sum. It says any sum received by the unit holder which are not in the nature of interest, dividend or rent, as income from other sources. So, and it also provides, there is a proviso proposed to be provided in the finance bill, which says that when this payment or this sum is received pursuant to redemption of units, then while taxing the said amount, you have to reduce the cost of acquisition of that unit. So net amount only at the time of redemption you have to bring to tax if it is happening at the time of redemption. Now, so in sum and substance, in my opinion, what is happening is that the entire payment or distribution by way of from the business trust to the unit holder, now it will be taxed as income from other sources. Otherwise, if the distribution is happening at the time of redemption, it may have been taxed otherwise as capital gain or otherwise, but now by virtue of this proposed amendment, everything would be taxed as income from other sources. Now, with this, several, I'll just illustrate the implication or import by way of this example. Say, for instance, someone acquires a unit of a REIT or NVIT at the cost of 100. So cost of acquisition is 100. Now distribution of the repayment by way of repayment of debt or return of capital, where without redemption, say it is 80 or it may be 100, and so in the present situation, this was not getting taxed at all prior to amendment as the statute exists now. Likewise, at the time of repayment, if it is happening at the time of redemption, so if 80 rupees or 100 rupees and your cost of acquisition is 100, you would not be paying any tax. But if at the time of redemption you are being paid 150, say higher than cost of acquisition, so you are paying tax on the net amount of 50. Now, and then correspondingly your cost of and that payment of 50 is happening is being made at as capital gain. So you would have the benefit of paying lower tax if it is long term or anything like that. Now, by virtue of the proposed amendment, so everything which is being paid, whether by way of repayment of debt or return of capital, is getting taxed at the time of payment itself. So, in the hands of the unit holder. So, in the first situation where there is no redemption, payment is being made without redemption. So, 80 rupees, whatever is being paid would be taxed at 80. 100 rupees also, if it is paid, it will be taxed as such. There is no deduction of the cost of acquisition or 100 that of the cost of acquisition and provided at this stage. And if this repayment is happening at the time of redemption, by virtue of proviso to section to clause 12 of section 56(2), as it is proposed, you can claim deduction of this cost of acquisition up to the extent it does not make the income negative. So since 80 rupees is being paid, cost of acquisition is 100, so you will claim deduction of 80, and you would not pay tax at that stage. And if it is 100, again 100 would be deducted, and there would not be any tax payment involved. But if your repayment is 150 at the time of redemption, then since cost of acquisition is 100, so you would pay tax as income at 50 as income from other sources. So one significant change that is happening is, while in the present situation you are paying tax on the same 50 as capital gain. while now in the proposed scenario, you are paying tax as income from other sources. That is one aspect. Secondly, in this cost of acquisition remains intact. There is no change. So cost of acquisition of even if everything is repaid, you have this 100 as the cost of acquisition, and I don't know how to in what manner and how you'll benefit from this. One scenario which we have not possibly plotted here can be that if, say for instance, at the time of redemption, this 150 is say is split in two parts. So say for instance, out of this 150, 100 is paid upfront, 100 no, say for instance 70 is paid upfront. So in the prior year, in the penultimate year, so 70 would get tax as such. So you would have to be paying tax on 70 as income from other sources, and then the remainder, that is 80, which is paid in the next year at the time of redemption. So that 80 minus 100, so you would not pay tax on that 80. So effectively, in that situation, you are paying tax, a higher tax. You are paying tax on 70 instead of 50. So this is the mechanics. This is how it works. So now, do you want to wait a break, or?
I think Ajay ji had some important points on business trust.
I think I'll be calling the attention of the financial wizards and experts in this room. Frankly, this amendment to me beats all logic and principle. I am a unit holder. I have put in 100 rupees into this business trust, and this business trust has pooled money from several people, invested, and has collected, let us say, 1,000 rupees as its corpus. It has invested in some companies by way of equities, given loan to some companies. It has received interest income, received dividend income. They are supposed to distribute 90% to the unit holders, and therefore in the hands of the unit holders it will assume the same character as dividend or interest, and the unit holder pays tax. To this extent, this is fine. The business trust also receives back the loan from the investee company and then repays money back to me, which may be up to the 100 rupees that I invested. What this is seeking to do is tax that amount that I receive, which is my own capital, which I get back as income from other sources. And it says, whenever you receive further money at the time of redemption, we will reduce the cost of acquisition or the cost that you put in. To my mind, the simple question will be, if I am getting my own money back, be it in the form of repayment of debt, how does it become income? By any deeming fiction, it can't become income. Up to the 100, you can't tax me. Any accretion above 100 will be taxable. And that accretion above 100 will happen and will be paid to me at the time when there is redemption of the unit, in which case it should be capital gains. The government is on record saying that this is leading to a lot of leakage. There is dual non-taxation with respect to this investment. Frankly, it beats my understanding. I have not been able to follow that. If you get back money, your cost will go down to that extent. To that extent, the value of your unit will come down. Even the NAV of the unit will come down, because the business trust is paying back money, so the deployable capital is reducing. So the NAV will also reduce. And corresponding to that, you will then be paying taxes at the time when you receive money above the principal value that you've invested as capital gains. But somehow this is what is sought to be conveyed by the government, that they are seeking to plug this loophole as if there is double non-taxation on this issue.
Not only the head is changing.
Yes, yes.
From capital gain to income from other sources. So tax incidence would be 30% plus whatever.
That's right.
Yeah, there are. My colleagues would cover.
Not for this.
Yeah. We can take a 10-minute break.
Yeah.
Yeah, is that fine? We'll take a 10-minute coffee break. 11th minute the door will close. So let's be quick. A lot more ground to cover. We are just getting started. Yeah. Is going to be dealing with some more interesting amendments.
Should I start?
Yeah, please.
Yeah, good afternoon, everyone. So, I think this is part of the relay race. I am the next runner who will be taking you through some of the important amendments. Primarily, I will be concentrating on some of the contentious issues and some of the issues which may hurt the taxpayers, rather than taking you through slide by slide with each and every clause. So the first aspect which we are going to deal with is with regard to the taxation of charitable trust and institutions. Now, as we all know, in taxation of trust, there are basically two regimes. One is section 1112 regime and the second is section 1023C regime. Broadly, the two regimes are at par. So the provisions are at par. The only distinction is, insofar as 12A regime is concerned, the definition of charitable trust has various limbs, and so if you fall in any of those limbs, you can get yourself registered for the purpose of 12A regime. 1023C has various clauses wherein you have to be solely for a particular purpose. So if you are solely for educational purpose, you get yourself notified under a particular clause. If you are solely for hospital, so you get yourself notified under a particular clause. If you all would recollect, in the last budget, there were few important amendments which were made by the legislature. So what used to happen is, trust is like it is different from a concept of a commercial. It is just like a commercial entity, different from what a business entity is like. So trust, the concept is application of income. So if you have some income, so you have to apply that income, and then there are certain rules. So you have to apply 80% of the income in a particular year, and if there is a deficit, you can you can make an application for accumulation of that deficit and apply it over a period of 5 years. Earlier the controversy was, supposingly you take a loan. Now out of the loan funds, you make an application of income, you apply it for charitable purposes. So whether that amount which is applied not out of your income but out of loan funds, whether that will be application of income in the year in which you spend the money. Similarly, another controversy was in case of corpus funds. So corpus funds, so if you receive any donation towards corpus funds, that is not treated as income in the hands of the recipient trust. So the issue was, if you receive a corpus fund and utilize the money for the purpose of charitable purposes, whether that is application of income in the year in which you make the spending. So the amendment which were made in the last year was that out of the borrowings, if you spend the money, it will not be regarded as application of income in the year in which you spend the money, but it will be allowed as application of income in the year in which you repay the loan. So therefore, supposingly you repay the loan after 2 years, in the year in which you actually spend the money, it is not allowed as application of income, but it will be allowed as application of income in the year in which you repay the money. Similarly, for corpus fund, the amendment was, in the year in which you actually spend the money, it will not be allowed as application of income, but when you recoup the corpus, so if you receive 10 crores as corpus in year 1, the law requires now you to keep that 10 crores in a separate bank account or as part of a separate corpus. You can't utilize it out of that 10 crores. So if you utilize 1 crore out of that, 1 crore is not treated as application of income in that particular year, but when you recoup the corpus and the corpus again comes back to 10 crores, it is treated as application of income. Now in the year in which it is recouped. Now the amendment which is now proposed, and then there are certain fetters which are applicable. So for example, you cannot make a donation, so again you cannot make a corpus donation. So for example, if you take a loan, out of the loan you cannot make a corpus donation, that is not allowed as application of income. And there are few other fetters which have been placed. Now the important amendment which is being done over here is now, as presently you can repay the loan over depending upon the tenure of the loan. So for example, a charitable trust take a loan for 10 years. They would obviously repay the loan over a period of 10 years. Now the proposed amendment is, we will allow you application of income only over a period of 5 years. So take an example, charitable trust take a loan of 10 crores in year 1, uses it for its charitable purposes in year 1 itself, and repay the loan over a period of 10 years, say 1 crore each. Now the earlier 1 crore would have been claimed over a period of 10 years as application of income. Now the amendment is, you can claim only over a period of 5 years. So you will be able to claim only 5 crores as application of income in next 5 years, and the rest 5 crores actually is lost. It will never be allowed as application of income. So this appears to be a problematic amendment which has been done, because there seems to be no rationale. The rationale which has been given in the memorandum is that people keep on deferring the the repayment of loans. Now a charitable trust, now you are actually insisting on a charitable trust to take a loan only for a period of 5 years. That is one important amendment. The same also is been done for a corpus. So if you received a corpus and if you are not able to recoup the corpus in the next 5 years, you will not be allowed the application of income. So you receive 10 crores as corpus fund. Out of 10 crores you utilize the entire amount, but you are not able to recoup the 10 crores over a period of next 5 years. So to the extent you are not able to recoup the corpus, that will never be allowed as application of income to the charitable trust. Another very important amendment is, this amendment took place from 31st March 2021. So supposedly you took a loan prior to 31st March 2021. Now if you see the ITR forms, for example in assessment year 2015-16, you took a loan of say 100 crores. Now that 100 crores was utilized for say construction of a building. Now the ITR form, if you see for assessment year 16-17 or 15-16, it specifically said that in the year which you utilize the money out of the borrowed fund, it is not allowed as application of income. Only to the extent of repayment of capital it is allowed as application of income. So in 15-16, you would not have claimed the amount as application of income for construction of building of 100 crores. And under the premise that 100 crores will be allowed to you as and when you will be repaying this loan over a period of 5 years, 10 years, or whatever is the tenure of the loan. Now the amendment is which has been made is, all loans taken prior to 31st March 2021, its repayment will never be allowed as deduction, as application of income. So you completely lost the benefit of a loan amount which is utilized for charitable purpose, and when you have not been allowed at the time of original application for charitable purpose, and you are completely denied of this benefit for the entire life of the charitable trust. So you will keep on receiving the money. So look at the anomaly. I take 100 crores as loan, I constructed a building. Now that amount will be repaid out of the income which I generate. Next year I earn an income say 10 crores. Say for example March 23 I earn an income of 10 crores. I will apply 2 crores for my revenue expenditure, 8 crores for repayment of loan. Now that 8 crores will not be allowed to me. My only application out of 10 crores is 2 crores. So there is a deficit because I was supposed to apply 85%. And I will never be able to complete that deficit. So this will actually lead to taxation of, because of non-allowability of an amount because of the bar which has now been created for loans and corpus funds taken prior to 31st March 2021. This according to us is a very silent amendment, but probably has not been realized that the implication it will have on all charitable trusts.
So there should have been grandfathering of the earlier loans.
There should have been. In fact, the grandfathering should have been that for loans prior to 2021, they would still be governed by the old principle. So as and when you pay over a period of tenure of the loan, you will be allowed as application of income. But insofar as new loans are concerned, you should be allowed deduction, if at all, over a period of 5 years. But there has to be some rationale of this 5 years also, because if a loan is taken, say for example construction of a building, for say for example for an hospital or a school, you require huge funds. You take 100 crores as loan for construction of a building. It is not possible to repay it over a period of 5 years. Now the restriction is only the repayment within 5 years is allowed as application of income. So that I think is a very important amendment which has been made, and which according to us is not probably in line with the legislative intent, and this will lead to huge draconian consequences. that is not allowed as application, so you have to, satisfy that 85% criteria based on other expenditure. So you can only make donation presently, you can only make donations for non-corpus purposes. Corpus donation out of the current year's income is not permitted. No, no, from now on, from next assessment year, this provision is applicable. So for 5 years, so from the date of, so sir, basically it says that you have taken a loan of say 100 crores, you start constructing a building. Now for charitable trust, as soon as you make spending, you spend the money, it is treated as application, whether it is complete or not. So we claim it as soon as the amount is spent. Obviously, when you have taken 100 crores, you would have immediately utilized it. Otherwise, you will not withdraw the money to the extent of 100 crores. So you have utilized it. Now you have to repay it within 5 years. It has nothing to do with when you capitalize, not capitalize. And in fact, that principle is not being followed for the purpose of charitable trust. That's the principle is in any case not applicable. Sir, technically you are right. The corpus is supposed to earn money, and the money which you earn out of the corpus fund is supposed to be utilized for charitable purposes. That's the fundamental of a corpus. But why the amendment was made in earlier year was, so supposingly you received 10 crores as the cash or as donation, with a direction that this is treated as corpus. Logically, that amount should have been kept in the form of FD or some utilization for capital purposes, and the income which you earn from that utilization, or for example FD, should have been utilized for revenue expenditure. But what the misuse was found in the budget in the earlier year was that corpus was not treated as income. People were utilizing that money for revenue purposes and claiming it as application of income. So the provision which was brought was, if you utilize the money you receive for corpus purpose for revenue expenditure as application of income, it will not be allowed. Once you recoup the corpus, in that year it will be allowed as application of income. Now they are extending it further, that recoupment has to take place within 5 years. Yes. That's what I gave the example, sir. That's what I gave the example. So I take a loan of say 100 crores or take a corpus of 100 crores. I utilize it for repayment of loan. And the loan I repay out of the income which I generate. Now, if repayment itself is not allowed as application, I don't have the funds to apply it for charitable purpose. So this will actually result in a situation where I ultimately end up paying tax on this amount, because I will be short of the required application of 85%.
This is a general practice for charitable trust to take a loan?
Yes. In fact, you will find big institutions, for example, if you are setting up a school, now school you require 100 crores, 200 crores of funds, and they are taking loans, taking loans for the purpose of setting up of the school. There are hospitals, we are actually aware of live examples. And in fact, sometimes the promoter companies who sets up a trust, they also gives it, the funds it through by way of a loan. I also thought over it. Technically this will be a problem because this is actually, you are only replacing one loan with another loan. I also thought that this is possible. One, there is a practical issue, because it will be like a bridge loan. You will have to take a loan to repay the existing loan and then start afresh for another 5 years. Just see, you have to repay that loan.
Under the first proviso, there is a bar on this sort of transaction. It says about the current year income. So it only talk about the current year income. So if you want to claim the repayment, that has to come from the income only, and loan
Right.
is not an income.
So that's what I am saying.
taking the other
Technically
loan
that is not,
an
because
income.
you are recouping it from the loan funds only. So loan from A institution is being replaced by B institution.
But the repayment will not be allowed in that case.
Nahin. Because it has to be within 5 years.
Suppose I took the loan of 100 crores, okay, and sometimes it takes a time of 2 year or 3 year for making of a building, suppose for the school or any other thing. And between that period, because I have to repay the loan, and I got the donation from the so many institution or maybe from some donor.
That will be allowed.
So I'm making the payment, because we were talking about that should be from the current year income.
So see, there are two types of donation. One is voluntary donation, which are not corpus.
Yeah.
So they are treated as income for a charitable trust.
Yeah.
So that will be income, and if you utilize that income for the purpose of repayment of loan, it will be allowed as application.
But that cannot be from the corpus.
Because that is not income.
Yes.
Because 11(1)(d) specifically says it is not income. Now moving on, another important amendment which has been done is, normally if you make a donation, so corpus donation is not allowed from one charitable trust to another charitable trust, but donation for non-corpus donations are allowed. So the amendment which is now proposed is, so for example, if I income of 100 crores, instead of I utilizing it myself, I decide, alright, I give it to another charitable trust, the entire 100 crores. Take a simple example of 100 crores is given to another charitable trust, which again is a registered trust, 80G, 12A, everything is there. Under the existing provisions, the entire 100 crores is allowed as application of income, so you ultimately end up not paying any tax. So 100 crores is your income, 100 crores is application by way of donation. The proposed amendment is that if you make a donation to another charitable trust, the entire 100 rupees will not be allowed as application of income, only 85% of it will be allowed as application of income. Now this, logically this may not hit as insofar as tax is concerned, but this will create a logical problem. So if you have 100 rupees as income, now entire 100 is say given to another charitable trust, you actually don't end up having any money. So you have applied 85%, there is no tax as such, but balance 15% in law is supposed to be utilized for future purposes, but you don't have money to utilize it for future purposes. So to that extent, that is what we have given in the last example. There is an anomaly that there appears to be no logic. The memorandum says the principle why they are allowing it, that people were misusing it. So for example, what people were doing was they were setting up multiple trusts. One trust giving it to another, claiming 100 rupees, then another trust giving to C trust, C giving it to D. So everyone was deferring it for over a period of 5 years. So it was perpetually never applied, and it was treated as application of income. Now so therefore to curb that practice, this amendment is proposed. That's the rationale which has been given in the memorandum. But this has been applied universally to all the charitable trusts. So I think this takes us to the point that only to to pick up certain people who may be categorized as black sheep, you are actually applying the provisions universally to all kind of charitable trusts, which may be genuine charitable trusts, but they are also hit by these kind of amendments. So moving on, another very important amendment. Now if you would recollect, by virtue of the registration process was changed substantially in the by way of TOLA, which came in 2020. So the present scheme of registration is, you are entitled to initially a provisional registration for a period of 3 years, and you are entitled to a regular registration over a period of 5 years. So if you are a new trust, so for example, if you are a new charitable trust, you are supposed to initially make an application 1 month prior to the financial year in which you seek a registration. So if I were to set up in 31st March 2023, I will apply prior to 31st March 2023 in order to claim benefit from financial year 23-24 onwards. That is perfectly fine. So I make an application initially, irrespective of the whether the charitable trust has commenced its charitable activities. Under the new regime, you will first be given a provisional registration. If you, as and when you start the charitable activities, because it may take some time to start the charitable activities. After you start the charitable activities, within 6 months you can again make an application, and your provisional registration will be changed to a normal registration. So initially it is provisional registration, and then it is the normal registration which is given. This at times creates anomaly in a situation where you set up a new trust and it has commenced the charitable activities also. So therefore the existing provision says that you have to make 2 applications, one for registration as a provisional registration, and then simultaneously make an application for a full registration. That anomaly is sought to be cured by the proposed amendment to say that in case you have already commenced the charitable activities, then instead of you making first an application for provisional registration, you can directly make an application for a normal registration, which is a full registration. That is one amendment which has been proposed. The second important amendment is that as we see that we have to we have to get ourselves registered from provisional to normal registration after every 5 years. So earlier the registration was granted for perpetuity. Now the registration is only granted for a period of 5 years. After 5 years, I have to again make a registration. Again make an application for the registration. Now under the existing provision, what you will find is you have to make an application within 6 months prior to the start of the activities, or if your registration is ending, so for 5 years it is given, you have to apply prior to the expiry of 5 years. There is no provision for condonation of delay. So supposingly you are registered say from 2023 to 2028 for a period of 5 years. 2028 you have to again make an application so as to renew your registration for a period of 5 years. And mind you, there is no provision for condonation. So supposingly in a bona fide case, assuming you miss to reapply for the purpose of charitable trust for re-registration, and in 2029 you realize, oh, I should have filed an application for re-registration, then there is no condonation. There is an automatic, you will be treated as non-charitable, and on the entire accreted income, so entire fair value of the asset which you have, you will be subjected to tax as a commercial entity. So therefore one amendment which is important amendment which has been made, which of course is to remove an anomaly, is that in case you have started the charitable activity, you don't have to make 2 applications. Only 1 application will suffice. You can directly file an application for regular registration. But in another case where you have not commenced the charitable activities, you have to first apply for provisional registration, then move on to regular registration. But the important fact is you have to apply within 3 years or 5 years, depending upon whether it is a regular registration or a provisional registration. And if you fail to apply within time, then you will be treated as a non-charitable entity, and your entire assets, the fair market value of the entire assets, will be subjected to tax. So this is what we have highlighted in these slides, slide number 62, 63, etc. So what has been the change in the provisions over a period of time? And one is to undo an anomaly, but second is a draconian provision that if you fail to apply within time, you will be treated as a non-charitable trust. I think if I make invite comment, is it not too draconian or a harsh provision that there is no provision for condonation, and even for a 1 day's delay, which may be for some bona fide reason, you ultimately end up losing the charitable character.
Yeah, we were joking in a lighter sense. Rohit said that this may not have been the legislative intent. Intent over the last couple of years has been to clamp down on charitable trust. So whatever they're doing, possibly as per intent only. Ajay ji?
No, but I think this point that Rohit is making, a 1 day delay will expose you to this exit tax under section 115 TD, which is on the fair market value of the accreted assets. Now that is clearly very harsh, and I think the courts will ultimately have to step in to say that you need to condone the delay. or you need to probably go to CBDT in a 119 petition to say condone the delay in filing this application.
Correct. Or we can challenge it on the ground of manifest arbitrariness.
I think so. I think so.
You know,
We're just looking for the chance.
one way to look at it is that the government introduced a provision of this is completely, it just struck me, so I am sharing. Introduced a 2% CSR mandatory application of profits, right? So now they feel that let all the money be routed through that to some genuine smaller charities which otherwise don't get money, and some of the bigger charities, not that I am against them or anything, but a lot of them are these white elephants or these big elephants. They just don't move. You know, there are so many people, everyone says I am going to donate some $10 billion to charity, then they start their foundation, and all of it makes the front pages of newspaper. No one has ever gone and checked back. Has any of these big charitable trusts announced by these big industrialists, what have they actually done? No one has gone back. But bada headline aa jata hai, this person is going to donate 30% of his wealth to charity. If there is someone who has genuinely done charity, you had to give it to Warren Buffett, who donated 90% of his income and assets to the Gates Foundation in his lifetime. So I think the intent of the government, the larger intent is clear कि चैरिटेबल ट्रस्ट अगर करना है तो चैरिटेबल लोगों को करने दो, बिजनेसमैन को चैरिटी करने की जरूरत नहीं.
No, but I think the point Rohit is making is because of your inability to sift the genuine from the non-genuine, you are seeking to hurt, almost all people. There will be many genuine charities that are operating. There are many genuine charities that are operating. I am not holding a brief for.
Sir, I have a very fundamental question, because I come from we hold in the south some of these big temple trusts very close to our hearts. But I do wonder, when we make a donation, at least I don't think of ATG. So in case you want to do charity as an industrial house, as a business house, why should you think about tax? Very fundamental and philosophical question, which should be asked even as a policy maker, that why should charitable trusts need or these industrial houses sitting on hundreds of billions of dollars, why do they need a tax exemption to further charitable endeavors? In a country where today as per the Oxfam report, the top 3% is controlling 50% of India's wealth, and the bottom 50% does not even have 10% of the wealth. I mean, that is the inequality and disparity that we are seeing between the rich and the poor. And just a warning to everyone here, if you look at some of the Twitter handles who've been good at predicting some of the trends of this government, I have not been one of them, but some of them have said that they will do something big in their next term, assuming the election results go the way everyone is anticipating, to reduce this disparity, including some provisions which will catch people off guard. That is what they think is the Prime Minister's way of looking at things. There is a huge disparity. The government recognizes this disparity, and you may see, if this was like the middle overs of a cricket match, or this second or third day of a test match, जब कुछ नहीं होता है, action first day or last day पे होता है. First day when the pitch is green, and last day when the pitch is turning. ये middle overs हैं. The fifth day the turning pitch will come next year.
Yeah. Arun, if this was the second or third day of a test match, we could have debated this endlessly, but unfortunately we are out of time.
Yeah.
I could have held a brief for genuine charity. Otherwise your medical care, your education would become unaffordable to people.
Very true. Last point, my own uncle closed down a charity in the name of my grandmother, because at 65 he said, I can't look at all these compliances. So fair point.
Just 5 seconds. Actually, what has happened is that sometime in 2013 there was a parliamentary committee constituted which raised issues about these charitable trusts. Then in 2018 and thereafter there were reports from CAG which pointed out several red flags related to malpractices of several of the trusts. So I think this is what has led to these kind of situations.
Sorry for eating into your time.
So one important amendment I'll just quickly point out, because these are not very important or material amendments. there is a provision for rollback of exemption. So under 12A, if you find, there is a provision which says, supposingly in assessment year 2018-19, you are not registered, but in 2020-21, you get your registration, and your objects in assessment year 18-19 and 19-20 were same. So existing law gives a rollback provision that says that even if you have got yourself registered in 2020-21 and your objects are same in 18-19, 19-20 also, so based on your subsequent registration, you will be entitled to the benefit in the earlier years also, and your income will not be picked up for scrutiny. That provision has now been deleted, and the ground on which this has been deleted is that now you do not require a rollback provision, because you have to make an application prior to the year in which you actually require a benefit of registration. So that's why this provision has been deleted. And these are some of the judgments which upheld the rollback provisions. Now moving on, I think this I have covered, regular and provisional registration. And another important compliance issue over here is that this one. Now you have to file Form 10 and Form 9A prior to the due date of filing of the return of income. So this is an important amendment which has been made. I think this needs to be taken note of all taxpayers who may be filing their tax returns for charitable trust, that Form 10 and Form 9A is required to be filed before the due date of filing. So you will have to finalize your financial statements and file all this prior to the actual filing of the return of income. Another important amendment which is for development authorities, this has been subject matter of substantial litigation and recent judgment in this Ahmedabad Urban Development Authority. The issue was that all these development authorities, whether they are eligible for exemption under section 12A or not. So ultimately the issue was whether these are commercial entities or these are actually charitable entities falling in the last limb which says that any other object of general public utility. The revenue's case was that all these development authorities should get themselves registered under section 1046 rather than claiming the benefit of 12A. But the problem with 1046 was, one of the condition for non-grant of registration was that if it is a commercial entity, then you will not be granted registration under 1046. So the consequence was, if according to the revenue you are generating profits, even if you are redeploying those profits for development activities, then you will ultimately end up not getting yourself registered in 1046 as well as 12A. Of course the litigation was there as to whether or not they are eligible, but the Supreme Court in this recent judgment said that it will depend upon facts what kind of profits you are making. But they said that statutory corporations which are established under a statute or central or state act, technically their receipts, if they are only discharging their statutory functions for which they have been set up, they will not fall in the category of commercial receipts, but with of course with a caveat that you should not be making abnormal profits. Now to take care of this, a new clause 46A has been inserted specifically for development bodies. Now even if you are a commercial entity, these bodies which are established under a statute, they can get themselves registered under section 1046 capital A.
Commercial activity on the trust basis or on the project basis, because sometimes what happens is that trust in totality, they does not have the abnormal profits, but maybe one of the entity, one of the function have the abnormal profit that being offset by the other expenses being employed. So how it would be treated? Like
no, so if you see the how the law is structured, no, section 215 has various limbs which defines what is charitable purpose, except the last limb which is a residual limb, which is any other object of general public utility. All the limbs are also have the benefit of 11(4)(a), which permits you to undertake commercial activities. You undertake business activity so long as it is incidental or directly relatable to your main charitable purpose. So just to give an example, for example a hospital. So in a hospital you may have a chemist shop. So that chemist shop may be a commercial, maybe selling the medicines at commercial rates. That will be governed by 11(4)(a), and its profits can be redeployed for the purpose of medical relief through that hospital. That is permitted because it falls in the initial limbs. But if you fall in the last limb, any other object of general public utility, the amendment was made in 2018 from 1/4/2019 to say that you cannot undertake any commercial activity, any business, commerce or trade, irrespective of the fact that you redeploy the profits of that commercial activity for charitable purpose. And this judgment of Ahmedabad Urban was actually in the context of that particular amendment only. So the issue was this fell in the last limb. Their case was we are not doing any business and therefore we are not hit by the proviso. So to the extent of these institutions, the Supreme Court had decided in their favor. Few of the institutions were also decided in favor, but most of the charitable entities which were falling in the last limb, the Supreme Court decided the issue against them, saying that assuming even a particular activity is undertaken for commercial intent, even if the profits are redeployed for charitable purpose, you will be hit by the proviso and you will be required to satisfy the threshold of 20% of that whatever is there. Now moving on, in taxation of business profits, I think there is only one important amendment with regard to section 43B. Now there has been some confusion with regard to this. Shortly, the amendment is that if you see the MSME Act, the MSME Act provides that you have to make timely payments to the MSMEs. So anyone which is categorized as MSME, you have to make timely payments. Section 15 of the MSME Act says that if you have a contractual mandate that you will make the payment within a particular days, but that cannot exceed 45 days. That is one. And then the law says that if there is no contractual agreement as to how many days you will make the repayment, then the deeming fiction is you have to make the payment within 15 days. And thereafter there is section 16 of the MSME Act which says that if you do not make the payment within these time limits, so 15 days or 45 days, you have to repay the amount compulsorily along with interest 3 times the normal RBI notified rates. So you have to pay along with interest. In order to provide for timely payment of money to the MSMEs, section 43B has been amended to provide that if you make payment beyond the time permitted under section 15 of the MSME Act, then it will be allowed deduction only on payment basis. So I'll give you an example. Supposingly a bill is raised by an MSME on you in say January 2023, and there is no contract, so you are required to make the payment within 15 days. If you don't make the payment within 15 days and you don't end up making the payment by 31st March 2023, that deduction will not be available to you. It will be available to you as and when in subsequent years you will make the payment to the MSME. So that is one example. The second example could be the bill itself is raised on 31st March 2023. Now that 15 days period will fall in the next financial year, which is 15th of April 2023. In that situation, if you make the payment within time, you will be able to claim the benefit on accrual basis. Then you don't have to go to a next year and say that you will only be allowed payment on a payment basis. So the law as has been amended is, if you make the payment beyond the time prescribed under section 15 of the MSME Act, the payment will be allowed only on payment, the expenditure will be allowed only on payment basis. It will not be allowed on accrual basis. But if you make the payment within time, it will be allowed on accrual basis. That's the sum and substance of this amendment.
Yeah, please.
Yeah. This applies only to small and micro. Please treat this. Deduction 43B affects micro and small.
Yes, MSME is what?
Micro, small only, please.
So I think I stand corrected. So it covers micro.
Micro and small. Micro and small.
Right, micro and small.
Rohit ji, one question from my side.
Medium is not covered.
Hello.
Hello.
Yeah. So, Rohit, question one, that does it apply to services only or to the goods as well? So let's say
Both.
No. So I am saying that when we say that deduction would not be allowed for the expenditure, so when we buy the purchase goods, so it's not a expenditure. I mean, anyone can claim that okay, it is lying in my inventory.
No, but you will have to debit it to your profit and loss account. Effectively, if it is lying in your inventory, effectively you are not claiming a deduction because there is a debit, there is a credit.
So the question is that practically, let's say the company follows the
This is
FIFO.
an old controversy which is going on for the purpose of this moderate credit also.
Yeah.
Where people were saying that 43B will apply.
Not this moderate principle will not apply.
No,
here.
but here his case is that if it is lying in the inventory,
No, but still
effectively
you
I
are
am not
making-
claiming this as an
I
expenditure.
think if you are making a deduction for purchase, I think it will be hit.
So it will be disallowed because of the debit to the profit and loss account.
Yes. Hello. Rohit ji. Yes, one question related to this micro small delay payment. So I'm just throwing one example where suppose there is a micro small entity from where we have bought some machinery, and the terms of contract is that 80% will be paying within this 45 days or 30 days. The rest 20% will be paying after the performance, that's say 6 months. So will that 6 month payment after 6 months fall under delay, or is it part of contract?
Part of the amount is to be paid after the time which is permitted under section 15, and part of it is paid before the due date. This is what your question is.
No, actually, my question is the terms of contract is 80% will be paying within 30 days, and the rest 20% will be paid after 6 months after checking the performance of the contract. My question is checking of the performance after 6 months.
No, there is a definition. I think there is some definition of initiation date that defines when you receive the goods, and we'll have to check the MSME Act. So whatever is
The MSME Act gives primacy Rohit, so that when the invoice is raised,
Right.
the amount becomes due. So if 20% as per the contract is payable after 6 months, then the invoice for that 20% also will be raised only after 6 months. You are not raising the invoice now. The important point is under the MSME Act, and many people who raise the invoice deliberately mention in that invoice that we are registered under the MSME Act. So the moment you say that, सामने वाला का alarm बज जाता है already. So therefore it becomes important. Then if it's 20% is as per the contract, why will you raise the invoice now?
Plant and machinery.
Because the invoice you will raise only then.
No, sir. He is asking, it is a plant and machinery. If the 100% is not being capitalized, a 20% if you say is after 6 months or after the performance, invoice will always be of 100. It can't be of 80. There is a
That's
catch
the
in that.
payment term which says 20%
That
has
is
to
only
be
a
made
payment
after
term
6
of a
months.
performance guarantee.
But this is tagged to the MSME Act.
That is agreed, but it has to be 80% or 100%. But because 20% is a very huge amount.
I think the gentleman's
this
question
will-
is different. His question is different.
But Arunji, because actually that says that the
By step, let's take one question at a time. So far as plant and machinery is concerned, my view is you are not claiming a deduction. So therefore 43B should not come in for purchase of plant and machinery for payment to a MSME.
So depreciation is there.
Depreciation, yes, depreciation is there, but that will not be an expenditure.
But
That's
sir-
an allowance, not an expenditure. So disputable issue, but largely in favor of the assessee.
But sir, why we should not see that whether it has become due, because the 45 days or 15 days would be applicable when it becomes due, because it has not become due because of the legality and or in the agreement itself.
No, see, if you read this amendment that is made, the amendment says any sum payable. Now the payable will be as per contract terms.
Yeah.
But if it is paid beyond the time limit, so the time limit will kick in, notwithstanding that the parties may have contracted to pay beyond the time limit. So therefore it will be hit by the proposed disallowance.
I think this is all defined, covered by MSME Act, because we also don't know the exact, but there is a specific date, some incorporation date or institution date is defined, and it has various limbs. So, and this 15 days period starts from that date, from the date of the invoice, date of the receipt of the goods or whatever. So the short point for the tax purposes is that if it is beyond the time permitted under the MSME Act, it will be governed by 43B. If it is within the time permitted by the MSME Act, it will not be governed by 43B, it will be allowed on accrual basis. That's the short. the amendment which has been made.
So there will be no disallowance on account of depreciation in this case.
Depreciation is not an expenditure. I think that's what sir clarified. There is a judgment also. In fact, the Supreme Court in Mahindra and Mahindra also considered this, because there also the issue was the depreciation. We will cover this and when we come to 28.4, the same argument was raised in the context of 28.4 also, because you are getting the benefit in the form of depreciation when you purchase an asset out of the loan, and therefore it will be covered by 41(1). And Supreme Court specifically in Mahindra and Mahindra said that depreciation is different from expenditure.
Yeah, I think
that's an allowance.
Now I'll have to really play my role as a not as a moderator, as a timekeeper to the hilt. Rohit.
No, I'll first.
We have to run faster than the Vande Bharat Express.
Yes. No, I'll just skip some of the slides which are not will not say these are important, not important, but these may not require a detailed discussion. So I'll come to the important slide because of the paucity of time. The exploration and
Arun didn't announce is all these speakers will be available for pro bono consultation during lunchtime.
only till lunchtime.
Yeah, I think that is a caveat which should be added.
Thereafter our clock starts. So ये mineral oil वाला कर 44 triple V. So this, I'll just quickly point out what this, the controversies in the context of 44 triple V was, that the people who are, providing the services or plant and machinery for the purpose of extraction of mineral oil, they are governed, they can claim the benefit of presumptive taxation. So 10% of their receipts are deemed to be their income. So many of these assessees, in fact most of them are non-resident, they were claiming the benefit of presumptive taxation, and the year in which they were suffering the losses, they were opting out of the presumptive taxation and claiming the set-off against the amount computed on presumptive basis. So the law which has been amended is that now you cannot opt in and opt out. So if you are governed by a presumptive taxation, you cannot claim the benefit of the losses. That's the sort. In fact, this controversy is still there in the Supreme Court in some of the cases. So I think they have curbed that issue. Next important amendment, this inventory valuation. In fact, as you know, 142(2)(a) permits the CIT to make a reference for a special audit. Now there is a new amendment which says that he may not make it for special audit, but only for the purpose of inventory valuation. Of course, subject to satisfaction of similar conditions of 142(2)(a). So that is a new provision which has been inserted. So it will not be a complete special audit per se, but it will be only for inventory valuation.
Question to you: if you value your inventory at lower of cost of market value, what's the intent of this? Cost is known.
It is basically a deferment, timing issue.
No, cost is known.
No, to determine, because allocation, probably, ultimately the issue will be of allocation.
Allocation to?
Allocation to the inventory, whether the entire cost has been allocated to the inventory or not. Because physical, I think, cannot be done, because the year has already gone by. So physical, or for the purpose of verification from the books of accounts.
No, but tell me, your closing inventory becomes your opening inventory.
Ultimately,
so
it's a timing issue.
What is the purpose? Huh? You will have another person sitting on your head to try and
only a timing issue. Yes, it is only a timing issue. But this is over and above that. Today you are getting your books accounts through as a statutory audit, but you can still be subjected to special audit. And the law specifically has been amended that you cannot take this as an argument. Another important amendment, I think, which I wanted to deal with at some length, subject to time for 5-10 minutes, is 28.4. I think, which is a huge, setback, I would say, for the amendment. I am taking that one only. Directly I am coming to that. So 28.4 I think is a very important amendment, and this is going to hit the entire IBC law as per our understanding. Just to point out what the controversy is. No, supposingly there is a company which is in a distress. Now that is treated as a corporate debtor, and that is referred to an IBC process for the purpose of resolution. inherently any scheme, any resolution process will involve haircuts. So a company may have taken loans. So I'll just give, so for example, just take this balance sheet. There is a company which has a share capital of 100 crores. There is a loan of 1000 crores and there are interest payable of 200 crores. And these are all genuine loans taken for business purpose. And the right hand side we have not filled, but there can be varied situation. Right hand side can be in the form of debtors, which may be realized, may not be realized. It may be in the form of capital work in progress, which may not be allowed to you as deduction because the project may have failed. And there can be deferred revenue expenditure. There can be various examples. So the short point is, out of when you will enter into a negotiation through the IBC process of this, you know, this when this company will be taken over by a new resolution, some resolution applicant, which will be a new management, they will of course bid for this company, and say for example they bid for this company at 300 crores. Now the loans of 1200 crores, 100,000 crores of principal amount and 200 crores of the interest amount will be settled at 300 crores. And the banks takes a sacrifice to the extent of 900 crores, and that will be written back in the books of this company and written off in the books of the financial institution. This can also happen in the form of OTS without an IBC process, etc., etc. So this issue came up as to whether this amount which you write back, for example loan and interest, I am assuming for a moment that interest has not been allowed as deduction earlier, because usually banks and financial institutions interest is allowed on payment basis under 43B. So for the purpose of our discussion, we are assuming that this 1200 crores has not been allowed to you as deduction in an earlier year. So out of this 1200 crores, 900 will be written back to the profit and loss account of this corporate debtor. Now the controversy or the issue is whether this corporate debtor is supposed to pay tax on this 900 crores which is written back. So the Supreme Court in Mahindra and Mahindra, because there were two sections which are applicable, section 28(4) and secondly section 41(1). These are the two sections where the department used to argue that this amount is taxable, this 900 crores which is written back. So the Supreme Court in the old case in Mafatlal, which was applied by Supreme Court in the case of Mahindra and Mahindra, actually held that 28(4) only covers non-monetary benefits. So benefit in form is only covered by 28(4). Monetary benefit, for example cash waiver of loan, is not covered by 28(4). So applying this proposition of law, the opinion across the industry was this 900 crores will not be subjected to tax because this is in the nature of a monetary benefit and strictly technically not covered by section 28(4). And 41(1) cannot apply because I have not claimed this amount as deduction or an expenditure in an earlier year. The amendment in the last budget, you would all recollect that 194R was inserted to provide for TDS being deducted on perquisites. And if we see the memorandum in the last budget, it said that 194R is sought to cover benefits falling in section 28(4). But when we went to the circular which was issued by the CBDT explaining the the working of 194R, there was a clarification which was issued that even the write back of loans will be covered for 194R, and there was a huge issue which was raised by banks and financial institutions, because that TDS would have then been required to be deducted by banks and financial institutions. So they went to the ministry and said that against 1200 crores I am receiving only 300 crores. Now you are asking us to also pay the tax on that 900 crores. Who will fund that tax on 900 crores? So a clarification was issued by the CBDT saying that the provisions apply, amount is taxable, but for the purpose of TDS, in order to remove the difficulty, we are clarifying that TDS will not be deducted by banks and financial institutions. Now to take care of, now to dilute the principle of Mahindra and Mahindra, a specific amendment is proposed in this finance bill to say that even monetary benefits, cash benefits, because loan is being waived, that is regarded as a cash benefit. So when the loan is being waived, that will be regarded as income under section 28(4). If we, of course, most of us would have seen, bidding for companies under IBC process, one of the fundamental principle or the viability of takeover of the company is that, you know, there is no tax to the new investor or the new promoter which is coming in and bidding in for the company. Now, this is actually not an issue relatable to prior to the insolvency date. This is an issue which will arise out of the after the implementation date, and therefore this is not hit by the, you know, the scheme of extinguishment, etc. So this will be a huge tax liability which will be taken over by a new investor or a new promoter which will take over the company under this IBC process. So if he takes over the company at say 300 crores, so he will have to pay 300 crores to banks, plus he will have to pay tax, he will have to pay also pay tax on that 900 crores. So on assuming a 25% rate, so they will have to pay around more than 200 crores of taxes. So the cost of the company taking over of that new company will be 300 crores to banks plus 200 crores of tax liability. Now this issue I think was raised by sir also yesterday before the representatives of the government, and the logic they said was it is taxable, you claim the benefit of losses and claim the set off, and therefore this you will have to bear. But this indirectly he said that it is taxable. So I think according to me this is a huge industry issue. Probably there may be representations, but this will actually kill the resolution process under the IBC, because this will be a huge cost insofar as when you are, you know, going for takeover of the company. So this I think is an important issue.
Be a litigation issue. If you remember, I think all these judgments that you have cited, Jindal Equipment was done by us. Now there the proposition that was canvassed in the court before Mahindra and Mahindra came in, the argument was that I am not in the business of raising loans, and this 28(4) applies to benefit or perquisite arising in the course of business. So the argument that was raised was, I am not in the business of raising loans. Loan is only a source of funds, and therefore you cannot tax the waiver of loan as a benefit or perquisite arising in the course of business. So that's one argument. Second, there are many other high court judgments, and high courts were divided that if there is a waiver of principal amount of loan, it's a capital account transaction. So therefore it should not be taxable even under 28(4). Some courts made a deviation and said, look at the utilization of the loan. If the loan was utilized for capital purposes, then the waiver would not be taxable under 28(4). If it was used for working capital purposes, it would be taxable, the waiver would be taxable, or remission would be taxable under 28(4). That entire list is not here, but this controversy was there, and the entire batch of cases went to the Supreme Court, and the Supreme Court in Mahindra and Mahindra did not deal with the manner of utilization of the loan, but held that a cash, a monetary transaction, which is the waiver of loan, will not result in taxation under 28(4). So that has been sought to be negated by this amendment that is proposed. But the old arguments, I think, will still revive, and this will be a matter which will once again get debated in courts. Apart from the dampener it will cause to, you know, genuine attempts at rehabilitation and revival of companies which are before the IBC.
So sir, this will cover the scenario in where this provision for this loan is made and not actual write-off is happened. In that year, it will be also taxable.
No, I am not able to see where.
Yes, sir.
Sorry.
So if provision is made for loan and actual write-off is not done, so in that year
but
also.
Ultimately, at some stage you will have to write back. No, supposing the 1200 crores is settled at 300 crores.
Yes.
Your statutory auditor will not permit you to carry forward that 900 in your financials.
No, suppose I have
there
already.
There is a haircut of 900. No.
Suppose I have already made a provision for the loan, and
prior to the process.
Yes.
In fact, this may be a route. In fact, I was also thinking about it, that probably what the resolution professional will have to do, he will have to write back the loan prior to the scheme itself getting implemented. So
how can you know
on the basis of estimate?
No, how can you know the quantum?
So this may probably be one way out, that if resolution professional makes some estimate based on some negotiation with banks, you know, write back the loan to the extent of expected waiver, pay it, and file the return saying that this is income in my hands, and that will get extinguished under the resolution process.
But on the basis
so
of
this of course is
that bid document can't make this
subject to
the bid document that you submit and put in public domain.
So this will only a book entry.
No, the bidders will make a. No,
There is
you have
no-
to put out. You have to put out. No. You have
No,
to
but if his point is if I make a provision.
Pre-COC, where interested people come and bid. They are looking at the liabilities and.
No, but I can bring it to a fair value. So for example,
doubt very
assets.
much. I doubt
Assets
very
also I impair. So probably, I don't know, this all will have to be explored because this amendment has now come. Probably all minds will start, thinking about how to get over this. I think this may not be a correct forum to discuss this, but probably otherwise this is a great dampener for the entire IBC process. That's the short point.
But sir, in this case,
Sorry? Which higher haircut? Yeah. No, but they will not agree, no. They are losing the money then. That's why they represented for the purpose of 194R. No, banks, you see, 194R only require 10%.
What Rohit said, that the cost will become 500, no? So whoever makes a bid will have to factor this in. Suppose the banks are only willing to take a haircut up to 900. They want to receive the 300. This will be additional cost, the 200 tax will be additional cost to the incoming promoter.
Otherwise, what you are saying is they will only receive 100 and 200 crore will go to tax. But banks will not agree, no? Against 1200, they will receive only 100. So this is all practical issues. In fact, that's what we are saying. For 194R, they were only supposed to deduct 10%. So they were finding even that 10% difficult. Here you will have to pay tax at 25%.
sir, one more limited point. This will not cover only the cases where IVC companies are.
Everything.
Everything.
We just gave an example. In fact, if you see our slides, we say all kinds.
So, though companies which are not under IVC, otherwise corporate loans are given, then if provision is made and return of happens in a subsequent year after this amendment, so whether it will be applicable.
There will be an issue as to which year it will be taxable, but after the amendment it will be taxable.
Yes.
Under 28(4).
But I am saying the scenario in which return off is happening after amendment, but provision is made before amendment.
I think this will have to be seen.
Yes. Okay. Thank you.
Rohit, can we move to 54,
Yeah.
54F?
So I think we'll just cover two, three very important amendments. One is 54, 54F. Presently, as we all know, in fact, all individuals take benefit of this 54, 54F. That if you sell a property and you reinvest into another property, then that is allowed as exemption under 54, 54F. Now the amendment which is proposed is that there is a capping of 10 crores. So if you sell some, jewelry or some asset, and if you want to acquire a property of 15 crores, so that in that situation you will be allowed exemption only to the extent of 10 crores, and on the balance capital gains of 5 crores you will have to pay tax under section 54. I think one important, the fall through of this is joint development. So many, you will find many of the individuals who may be staying in some of the areas which are one of the poshest area, they usually enter into a joint development agreement for, reconstruction of their property. So for example, someone residing in Panchil or somewhere where the value of land itself will be substantial. So they enter into an agreement with a joint development with a builder and say that you construct 2 floors, 4 floors, 2 floors you keep it and 2 floors you give back to me. Now in that situation, we normally, our principle which we used to follow was, if the person who is entering into joint development agreement is not receiving any cash consideration I mean anything by way of check, and you are only receiving it in the form of, built up area, there is no problem because everything gets redeployed and 54, 54F takes care of that, there is no tax liability. Now you will have to do a working as to what you are getting as consideration, and if it is more than 15 crores and the reinvestment cannot be more than 15 crores. So I think now that mathematics will have to be done, and this might hit some of the joint development agreements in future.
Issue is when you work out the formula for investment of capital gains, the proportionate, that denominator will also be 10.
No,
No,
what they have
that
done,
said.
what they have done, we checked up this aspect. So what they have done is they have amended the law to say that the cost of the new asset will be reduced. So for example, if you purchase a new asset of 25 crores, the cost of the new asset will be deemed to be 10 crores. So the formula works because it sees with reference to the capital gains and the investment. So therefore, to that extent, there is no anomaly. I think we can wind up. I think I'll hand it over to now Kavita because there is lot of race still to be done and then there is indirect tax also. Thank you so much.
So I'm the last batsman. And you know, with the time limit is also just 15 minutes. So good afternoon, everyone. And in fact, it's a pleasure to see all of you after almost 2 years. 2020 was COVID and 2 years we haven't met physically. So it's a pleasure meeting all of you after 2 years. So last 2 years, basically, the courts have witnessed litigation on 3 fronts. I'm talking about high courts. So various high courts in India, there are 3 major fronts on which they have witnessed litigation. One is reassessment. So every third matter which came to High Court was with respect to reassessment, whether it is an old regime or new regime, but it was reassessment. Second was with respect to faceless assessments and faceless appeals. The people came to a writ jurisdiction mainly on the ground that the principles of natural justice have not been followed. So in most of the matters, the orders were quashed, the matters were sent back to the assessing officer for de novo consideration. And third issue where SECs, again the taxpayers have come to court, was with respect to department withholding 20%, more than 20% of refund. So that was also one, and despite the fact that circular specifically says that you cannot withhold, that 20% is an amount which can be withheld by the department, but more than 20% cannot be withheld. So we have seen cases even in these areas where people had to come and rush to the court asking for a refund because department was holding and sitting back on the amount for more than 20%. So I am basically dealing, I won't be going slide by slide or clause by clause. I'll just be dealing with the timelines which have been given to align with the provisions already existing and the new provisions. So quickly I'll tell you that what are the new timelines which have been given. So first amendment which is there in section 153 is with respect to, we all are aware that timelines for completion of assessment was basically 9 months in earlier years. Now the timeline has been increased to 12 months. And the basic reason of 12 months, because I just mentioned few minutes back, was that the issues were raised by taxpayers that sufficient time is not given to them to give their reply, file their submission, and without even considering the submissions or reply, the assessing officer used to pass orders. In fact, the time even given, the time kind of a time we have seen the department giving to the taxpayers was 1 day. So the courts had to step in to say that 1 day is not sufficient for a taxpayer to give reply, or there is no proper opportunity of hearing which you have given. So in these circumstances, the orders were quashed. So the time limit for completion of assessments also has been increased from 9 to 12. Now, there is, in the case of search, we all know after 1st April 2021, so far search proceedings are concerned, now there is 153 and 153 that is no longer available. So 153B basically talked about that how the search assessment period, now there are no time limits per se. But now the time period, the 153, there is an amendment which says that the 12 months is provided to the assessing officer to conduct proper scrutiny based on seized material. So extension of 12 months vis-a-vis search proceedings have been given to the assessing officer.
Take 2 minutes of your time, just 2 minutes I'm intruding. Sorry. I think while you are on this search, very important point.
Yes.
That I think you need to be beware and put your house in order that you hopefully don't have a search. If there is a search today, the authorized officer may requisition the services of any police officer or any officer of the central government. So it will not just be the income tax which will be coming to your premises. They can requisition CBI, ED, whoever they think needs to be brought in. So this is extremely harsh, draconian, and I think people need to take care of their affairs.
But I think the search officers earlier were also assisted by police officers? The local. So, okay.
So Ajay is saying that not just for security reasons, but even otherwise.
Okay. So alright, so the time period has also been extended for a period of 12 months vis-a-vis search. Now, the other amendments is with respect to the 263, the provisions had been aligned to give for passing of order for consequential orders under 263. Now, so for inventory part is concerned, my friend has already covered that. Basically, to exclude the time limit which has been given vis-a-vis valuation of inventory. So that period is to be excluded as per the Limitation Act also. Now, we are aware of this face test scheme and e-proceedings. So there were a lot of schemes vis-a-vis e-verification scheme, dispute resolution, advanced scheming, face test scheme and faceless penalty scheme also. So under these provisions like 135A, 245MA, 245R, 250 and 275, the central government actually introduced various schemes to eliminate face-to-face interactions, and they had the power to issue circulars, but they had no power to amend this. So they, in fact, the practical difficulties which were faced by the taxpayers, they wanted to eliminate this, and that is the reason appropriate amendment have been brought in, wherein power has been given to the central government to even modify the circulars. So the power earlier was only to issue, now power also is there to modify the circular and to meet the difficulties so that timely appeals are disposed of by these authorities. Now, 148, 149, 148, 151, we all are aware that 7 days period was given for passing of D orders. That has also been given that it is more than 7 days. All right, so another important amendment which has come in. So as an SSC, we all are aware that prior to 1st April 2021, there was an unamended law which was available in reassessment proceedings. So the procedure was that once a reassessment, I'm talking about unamended, I'll talk about amended a little later. Under the unamended provision, the procedure was that once a reassessment notice is issued to a taxpayer, he was required to file his return of income, then ask for the reasons, file objections, and then if there is a rejection, you always can go to the High Court and ask for a quashing of that particular notice. After 1st April 2021, we have seen a sea change and there is an amendment. In fact, the GKN itself has been incorporated and it is there in the Act itself. So the Act says such period, if you really see the section, it talks about such period. So filing of return, there was no time period per se. So if a taxpayer gets a notice for filing of a return, generally in the notice it is written as 30 days or such period. So generally if you see, the tendency is not to file the return till the last moment the consultants advise them, yes, now the time has come, please file a return. So they have specifically given that within 3 months you are supposed to file your income tax returns or within the time stipulated by the time given by the assessing officer. In case if you don't do that, then what are the consequences? Consequences are that you won't get any notice under section 143(2). So we all are aware that 143(2) is a jurisdictional notice. So if there is no jurisdictional notice issued to a taxpayer, the stand which we used to take in court was that if there is no jurisdictional issue, any assessment pursuant to that is a nullity. Now that ground will not be available to us. So if we don't file the return within 3 months or within the extended period, we will lose the right of any 143(2) notice. Now, there's an amendment in third proviso to section 149 which talks about search cases. Suppose in a particular case, in a particular SSC, search has taken place on 15th of March, after 15th March, and the time limit to issue notice lapses on that financial year 31st March. So there is an extra time of 15 days which has been given, and it will be deemed that if you suppose that notice is issued on 15th April or after 31st March, it will be deemed as if the notice relates back to 31st March. So that 15 days time period has been given in case searches take place after 15th March in a particular financial year. So basically it is to time available for the assessing officer to collect information and pass orders. Now, so I'm not dealing with, I'm in fact skipping those which are not very necessary. I'm just dealing with the issue which is important. There's one important, in fact, if you see the memorandum also, another important point which I wanted to talk about is with respect to 241 and 245. So 241, basically when you see, it talks about that where a refund becomes due to an SSC under section 143(1) and notice for assessment under section 143(2) is issued, then assessing officer, after recording reasons for doing so with prior approval, he can withhold such refund till the date of such assessment is being made. This is 143(1), right? And but there has to be reason. But so far 245 is concerned, it talks about set off. It says that if any refunds are found due to any person and against any tax remaining payable, then the amount can be set off, of course, after giving intimation to the taxpayer in writing. Now, if you see the memorandum says that there is an overlap between section 241 and 245, and to mitigate this overlap, so there is a sunset clause which is now there in 241. It says that this will no longer be applicable after 1st April 2023, but so an entire everything has now been ingrained in section 245 itself. So when you see 245, it says that any refund which is due, so meaning thereby the conclusion is any refund which is now due to the SSE, that can be withheld by the assessing officer. Another question comes is that when we are talking about the 20%, that if an amount is more than 20% which is withheld by the assessing officer, can the department continue to withhold? This is another question which will definitely come to the court, but the memorandum is silent about it. What happens to these situations? So if you really ask me, I don't see there is any overlapping between 241 and 245. These are two different areas and they used to operate in the respective fields. So, but the memorandum says there is an overlapping, and they have tried to bring one particular provision so that overlapping goes. I think we can have some inputs from.
I think this will be another case where, writ petitions will go up to the court, where he can set off the refund or withhold the refund if it is likely to adversely affect the revenue. This was the impact of the earlier 241A, where the assessing officer would just issue a notice saying that the refund is withheld because it is going to adversely affect the revenue. They will have to spell out reasons why, according to them, giving of the refund will be to the detriment of the revenue. And this has been challenged successfully in the courts in several cases in the past. And I would think that if there is indiscriminate, arbitrary withholding of refund, one will necessarily have to knock the doors of the High Court to ensure that the refund is released. Because this is also to your prejudice, because the additional interest under 244 capital A 1A is not to be allowed for the period that the refund is withheld. So one will necessarily have to get to the court to get the necessary relief.
So in fact, there are three words, which is a sort of a booster for the lawyers. One is to reduce litigation, to enhance transparency, and to have accountability. These three words, when we see, we know the litigation is bound to happen. So this is exactly when we saw, earlier also we saw, the moment the word to reduce litigation is used by legislature, we know that this area is prone to litigation, and we are going to bound to have lot of litigation. So precisely this area also, I don't think we are going to close here itself. We are going to see a lot of issues and cases even in this area itself. So I think I have lived up to the expectation and the time.
Just one point, 10 minutes. The Joint Commissioner.
Yes, sorry.
I think DRP Joint Commissioner, nothing.
Okay, DRP. The Joint Commissioner one is only that to reduce the pendency.
To reduce the pendency, since there is a clog in the CIT appeal and they are not able to dispose of the matter. So one more Joint Commissioner is there. Again, there is also an area of litigation, because Joint Commissioner and CIT appeal, they will be prescribing rules. Then since now assessment is faceless and it is passed by unit, who is the prescribed authority, and because it is as per the approval, then where am I supposed to file, who is going to decide that? But since the line says it will be prescribed by the central government, we feel a notification will come, and then we'll get to know, we will file against Joint Commissioner or before CIT appeal. So this is also an area which I think will bring some litigation.
Cross appeals on DRP, which revenues cannot.
I'll just point out.
Yeah.
Yes.
Actually, DRP orders are otherwise binding on the assessing officer, and there is no appeal provided against DRP's order. Assessing officer cannot file appeal. Now it is proposed that
Cross objections can be filed in the tribunal against that order.
Objection can be filed by the assessing officer. So subsection 4 of section 253 is proposed to be amended. And wherever assessee is in appeal, so on other issues where relief has been allowed by the DRP, the assessing officer would be able to file cross objection. So there are going to be more litigation in the tribunal, as the department would increasingly file memorandum of cross objections against the DRP order. So this is an important amendment, so we thought we'll
I think according to me this is positive. You see, today the DRP does not give relief, saying that if the department is in appeal in some forum, they refuse to follow the order of the tribunal or high court, saying that this matter is pending at the instance of the department in the high court or the Supreme Court. And as a result, there is a demand created against the assessee. The assessee has to necessarily go before the tribunal, seek a stay of demand. Now, if the DRP is to treat this amendment in the right spirit, then in my view they should allow relief to the assessee if the matter is covered in favor of the assessee by any decisions, be it in its own case or be it by a high court, Supreme Court. And in that situation, the government can file a cross objection. So in which case, at least the demand will not be staring in the face of the assessee. So according to me, this is a welcome amendment, provided it is implemented in the right spirit. I would certainly welcome this.
So we have to give way to our indirect tax team. So thank you very much. Thank you. Thank you.
So now, Shammi and his team for indirect tax.
You know why we keep indirect taxes in? Because we know no one is going to get up now. GST has been giving sleepless nights to taxpayers, so they are going to keep us awake just before lunch as well. Can I do a quick dipstick survey? How many are more worried about GST than they are about direct taxes? Yeah. Can you raise your hands?
Not many.
Okay, how many feel that the GST issues are as, cumbersome as direct tax, or are mostly direct tax? Fine.
Anyhow, good afternoon everyone, and I think continuing on the themes that both Kavita and Arun has mentioned, I would like to highlight that the legislature is very clear that we want tax consistency, and at the same time it shows that we are moving forward towards a mature indirect tax systems where we don't tweak things too much over the course of a year, and the larger mechanics remain the same, whereas small changes are made every year. With that theme in mind, we also have to address the elephant in the room, that the judicial pronouncements in the past year in the indirect tax space in customs and GST have had wide-reaching impact, and they really have the capability of rocking the boat, so as to speak. On that, I would like to take Mr. Kapoor and Ms. Jha's opinion on, and they would take probably 2 or 3 minutes to take us through the 2 or 3 judgments that have come out this year. Yeah, let us speak about Northern Operating Systems and Mohit Minerals first.
Am I audible? Yeah, thank you. So I've been asked to bat in the last 20 overs in a 5-year match, 5-day match, sorry. With respect to GST, when it started in 2017, it was said to be one of the most simple tax. But in the last 5.5 years, we have noticed that, day in and out, there are circulars, notifications which come in. And has wide implications in relation to various aspects. Though we have noticed, we have got many good judgments in the last year. Philco Trading was one which gave a breather to many of the tax assessees in relation to filing of their Tran 1, though those matters, batch matters were there in the Supreme Court. Despite that fact, there is Northern Operating System judgment, though in the erstwhile service tax, but had implications which has given rise to many notices having been issued by the department to various, almost all companies wherein you have expatriates and drawing dual salaries, which is leading to a lot of tax implication, and the companies have to really give in with respect to payment of taxes on this aspect, even under the GST Act. This is again giving rise to a lot of litigation in the GST era. Mohit Mineral was one good judgment, though in stark complex when we see there is a lot of statements made by Supreme Court in relation to the GST Council, whether that the GST Council is not binding in nature, and therefore any recommendations made by the Council does not have much of a binding effect, which again has given rise to some of the states thinking it otherwise in the GST era, whether they can initiate their own and go back to the earlier system and come out with their own notifications and other things. These are some of the judgments which had implications. Recently, there are a lot of search and seizure cases which are happening both under GST and income tax, but GST they are making a lot of pressure upon the companies and people to deposit tax. In that case also, we have filed a lot of writ petitions before various high courts. If pressure has been made by authority when a search is conducted, during that time, even though there is a CBIC circular clearly stating that no demand or can be deposited during the period of search, but we have noticed that lot of in many of the cases the payment is though made voluntary, but actually the payment is under duress. So that has been challenged before Delhi High Court and Mumbai High Court, and the matter is coming up. Notices have been issued, and in fact stricture has been passed in Delhi High Court also in one of our cases. The other big matter we have seen is the case of intermediary, which is also we have filed cases in various high courts, and which are also coming up for final hearing before the Punjab Haryana High Court. Apart from that, the other judgments that Kavita would like to
since you talk about intermediary, because
Yeah.
it has got some implication vis-a-vis, whether how do you tax that? Because intermediary per se, when you are giving a service to a person outside India, so whether it is export or service vis-a-vis through intermediary, will it qualify under GST? I think you can talk about that.
So there, last year there was a circular which was issued in relation to intermediary, wherein they stated they had come out with 4 different kind of classes, stating that in what circumstances an intermediary could be created, wherein you have a foreign company having a wholly owned subsidiary in India, carrying out certain activity on behalf of the foreign company. So the department is of the view that in relation thereto, they would be treated as an intermediary because they are carrying out certain activity on behalf of the foreign party, which actually has a third party contract outside India. Though in our view, it doesn't qualify as an intermediary at all under the GST because it doesn't tantamount to supply. So therefore, since it is outside the definition of supply, therefore it could not qualify as an intermediary. Yeah.
In fact, the issue has not attained finality, so we are doing matters before Punjab Haryana High Court and also before Delhi High Court. And to put a perspective again, one of the issue which Mr. Kapoor was mentioning, that vis-a-vis voluntary and involuntary payment, so far section 73 and 74 of the GST Act is concerned, it talks about voluntary payment and involuntary. Moment you make a voluntary payment, you cannot ask for that particular cash or the amount, you cannot ask for that money back. But then we have cases where although it is coming under a particular section which says about voluntary payment, but the payment has not been made voluntarily. But then the question comes from a practical aspect, how do you show that? Because when you are before a court to tell them that look, this particular amount has been given out of duress and we have not given it voluntarily, the first question which the courts ask is, how do you prove that did he slap you? What exactly has he done? So we actually then we had to tell the clients that if you have made a payment and you were sleeping for 3 months and then suddenly you woke up that look, this particular money I have given out of coercion, you have to immediately take steps and say that this was not a voluntary payment. In fact, I was pressurized, and then I had to. Then another step where one can think about is that after this particular payment has been given, there has to be a follow-up. Like there has to be a proper notice, there has to be determination, there has to be order which has to follow. If these things are not happening, then definitely one can go to the High Court and ask for that particular amount, which has been although given under a section which is voluntarily, but can claim back. And in fact, entire batch is pending before Delhi High Court, and court is entertaining. They are definitely in favor of the taxpayers, saying that any amount of this kind which has been taken or cost by the taxpayer, by the officers, that can be taken back. So just to apprise of what exactly is happening on the ground level.
Yeah, the reason, they were all deposited under DRC 03, which is one of the form, though it was voluntary. But the courts are coming out heavily that in relation to why, what were the circumstances. In fact, there is a Delhi High Court judgment recently by Justice Chakdar in Web of Textile, which stated in so many clear terms what circumstances can be. So the courts are also very well aware that there's a lot of pressure put by these authorities when they come and visit and carry out search, and during that time circumstances are so created that the demands, whatever the demand is made by these authorities, both to deposit this amount in voluntary terms, that can be now claimed back by way of a refund, but we have to go by way of a writ, because this is otherwise not, you can't claim it back since it is deposited in DRC 03.
And in fact, one more issue which is very much there in the courts is with respect to revision. Like for example, now we know everything is e-proceedings. You have to file it by way of a particular portal, by particular system which is given to you. But if there is no step-down menu given to you, then you in fact can't revise your forms. For every small thing under GST, what we are seeing is that people have to go and knock the doors of High Court. That for tran ones, for revision, for clerical mistakes which are there and you're not able to take, for ITCs, for everything you have to go to the court. So even for those kind of things where your system doesn't say that you cannot revise because there is no step down menu, you have to go to the court and ask for that. I have done a mistake, it has happened, but I can always do that, clarification can come, or I can always do that correction. But now I think that amendment has come.
There is an amendment which essentially provides for a cap on that, and it was already amended. But anyway, let us just quickly run through the important parts of the customs and GST changes. I will not take much time. This is essentially plugging a loophole, because earlier the law had provided that all exemptions would be valid for a period of 2 years. Now, what the law is proposing to provide is that certain exemptions will continue to be in perpetuity unless they are withdrawn. Examples are provided in this list. Some of them were very important, such as multilateral trade agreements or bilateral trade agreements, obligations under UN, etc. This is in relation to the settlement commission related procedures. Earlier there was a provision which provided that all settlement commission cases had to end within 9 months, which could have been extended to 12 months by the order of the settlement commission. This was amended in 2015 to take away this cap on that settlement commission's time period. This has been reintroduced this year as well. Towards the tariff changes, we can see that this is again a mark of a mature customs system, that we are collapsing the number of various tax rates and we are reducing the variances in customs rates. So as to speak, if there were 30 odd types of rate items in BCD, now there will only be around 15-16 odd tariff lines. So this is leading to more of consistency. You would see that in mature custom systems, there are only 2 or 3 rate systems. It is only in countries like India that you have multiple tax rates. I'll skip through excise. There was a very minor change there, and quickly go over to the GST changes.
Main changes.
Yeah, we will just highlight some of the main changes here.
The important one over here is with respect to CSR. And we can see that in CSR, the GST credit has been disallowed now. This requirement arose because of some contradictory AARs which came, and one said that on CSR you can take credit, on one other said that on CSR you cannot take credit. But now this amendment has been inserted, which specifically provides that on CSR credit cannot be taken. I think the most important amendment under GST is the one which is there in one line over there, and I would just probably expand on it. 23 provides for registration, and 24 provides for compulsory registration for certain people. So 24 in a list provided that whoever had to pay under reverse charge had to in any case take registration. Now 23 says that notwithstanding what is provided in 22 or 24. So the one interpretation that can be taken is that someone who only has a reverse charge liability need not take registration, and therefore there is no tax liability on him because the machinery provision goes away. This would definitely lead to a lot of interpretational issues, and we are already seeing various thought processes on this. One intent that the government might have had is that since for a completely exempt supplier, that is entirely a tax cost, and that's why they don't want you to pay under reverse charge. But that really defeats the purpose of equalization, because a domestic supplier supplying services or goods to him, on his invoices there would always be tax which would be cost to the exempt supplier, but for a foreign supplier he would get the benefit of not making payment under reverse charge. So that this is an extremely volatile amendment. I mean, it has a lot of scope for litigation in future.
Arnab, just one question on CSR. I think your ITC will be blocked.
The ITC will be blocked.
But that's
Yes.
only for CSR company. If you have an implementation company which is working or carrying out certain activity on behalf of CSR company, then that ITC would be available to that implementation company. But for vis-a-vis the CSR company which is actually has to carry out that activity under section 135, 2% of their net earning in the last 3 years, whatever they have to spend. In relation to that credit has been blocked.
Yes, I will just quickly go over to the IGST changes because they are also important. The rest of the changes are mostly housekeeping changes, and they had already come out during the GST Council, and I don't want to take up more time with respect to that. In IGST, they have made a change saying that online information database access and retrieval would also include suppliers where not only it is automated but has human intervention. The reason that maybe this was done is because in certain cases like Byju's and all, you will see that databases are on the cloud, but there is also a person who explains those databases to students. So it essentially it used to create a situation that they would not have been covered under OIDAR. This actually clarifies that they would also be covered by OIDAR. I think there is a live dispute on this as well, Mr.
Yeah,
Kapoor.
we had actually taken it to DGGI also with respect to specific case of coding. A lot of coding companies had come to us who had actually carrying out activity in US and Europe, and in India they were all unregistered persons. But coding happens through a human intervention. So we had made out a case before the authorities that in relation to OI ADR services, if it is with human intervention, then no GST is applicable. So now, pursuant to that, I think we had a long fight over almost 3-4 years. We had a fight with the authorities. They have now come out with their clarification that irrespective of the fact, with or without human intervention, OIADS services, they will have to be registered. So this is opening up another Pandora box. But my question to you, Arnab, would be that how they would come to know, the OIADS services are being performed. It's very difficult to catch maybe Byju's and all these companies may be one off, but in relation to smaller companies who are rendering those kind of services which are available, how they are going to catch them?
So my yes, so my view is that it would always be the same mechanism that is already being followed by a lot of software streaming service providers here in India. They have already aligned their systems to bill for the GST within their billing system itself. You would see even small streamers who basically provide streaming services here in India, they also have a GST billing system on the basis of geolocation.
I think to answer Shami's point, my word of caution would be, please don't undermine the revenue intelligence today.
No,
when you say how will you catch them, no, today they have many sources of information, and you can assume that this transaction will duly be found out and investigated. I think don't move on the premise that...
No, I'm not.
Yes, there is a possibility that because of not violating the domestic laws, they may also ask the authorities under the IT Act to block those websites. So that power may also be built into the future within the statute itself. So that is yes, this is an extremely important amendment, and the rest of the changes are mostly housekeeping. But I think that what I really think is that the changes and the tax amendments which is missing in this entire PPT and which is coming probably within this year itself is the settlement related. Again, they are saying that what I'm hearing is that a settlement plan for all indirect tax disputes is in the pipeline. It was already expected in this budget. It did not come through, but one can expect that also. Not a very good news for practitioners and litigators.
No, but I think given the kind of an experience we have, Sabka Vishwas legacy dispute resolution also had so many issues, even tax arrears. So we had to go to the court. So moment there is even a dispute resolution also, I'm sure as lawyers we will find out ways how to go to court.
I think you are mistaken if you think you can go to the settlement and you can in the first meeting settle across the table.
Of course,
no.
Of course.
It will be a lawyer's paradise only. I don't think. So basically, income tax also has this dispute resolution committee. They have not formalized it as yet. They have not activated it as yet. While they abolished the settlement commission, I am told for indirect tax the settlement commission still works.
But the settlement commission works, but there is an amnesty scheme. So there is an amnesty scheme that is.
So they will probably come back with it.
In fact, authority for advanced ruling was not there. We had filed an application long back, and the dispute was with respect to that it was with respect to manning service. So whether service tax has to be paid or GST has to be paid, that was an issue pending before AR long back. But it was abolished. The Delhi jurisdiction was not bringing in this Delhi
AR.
Delhi AR.
Authority was not being set up.
But and since we had to pay that, as per the contract, we had to pay the amount and just ask for a reimbursement. And since this contract was with one of the hospitals, and the hospitals were not even ready to say that this is their liability. So again, we had to go to the court, and thankfully there is an order passed in our case only, where an AR now been established, and that all the applications which were there, filed 2 years, 3 years back, has been revived, and they'll be settling the issue once for all.
Yeah. So just one more part, I think, which is not there. Under the CST Act, initially a CST tribunal was formed. Now it has been made mandatory that henceforth, once the budget, this finance bill is passed, all CST related appeals will go to CSTAT under section 9. So that's just one. I thought I'll just make it mention it in the.
So that's all from me, my side. I thank my colleagues for the valuable
thank you so
insights.
very much, Arnab. Thank you so very much. It was great.
GST, only one comment that it has instilled fears in the minds of the businessmen. I can tell you from first-hand experience of my friends who run some startups, they are more spooked by GST. One notice, and I got a call from one of my friends who's a MD of a startup and said that arrest तो नहीं
Arun,
करेंगे
the problem
No, no.
with that is because of the power of arrest.
Arrest, yeah.
Moment, and in fact, even if there is an escapement according to them, which is 2 crores, and moment it is more than 5 crore, now 2 crore or 5 crore, they have a power of arrest.
Yeah.
They'll make sure that the amount is more than 5 crores so that they can go and again this voluntary, involuntary, they'll take that money and make that this is 5 crores. If you don't do that, then there's always a power of threat. So what he said is right. That that GST, that threat, because you there's a power of arrest.
Yeah, and second, you look at the Sessions Court judgments. I read some 15 Sessions Court judgment on some Sundays where you have nothing to do. A friend sent me, ye dekh, Sessions Court ke judgments in Bombay ke, go through it. So I read, not one case has the judge given bail or anticipatory bail. Not one case. He is saying that Telangana High Court judgment is there in PV Reddy, this is that is that. I am not accepting anything you are saying. Anything.
No, that anticipatory bail on fake invoices.
Yeah.
Yeah.
But on a lighter note, just to end, I an advice for my friend who is not married. If he has nothing to do on Sunday, he should have got married.
On behalf of the entire panel, I must thank all of you for making it on a Saturday morning, for a patient hearing, and for your wonderful participation that's led to insightful discussions and a learning for all of us. Thank you on behalf of the entire panel. Thanks Neeraj ji for inviting me to moderate this panel, and always a pleasure to be sitting on the same dais as Ajay ji. Thank you so much.
So, after several rounds of discussions, now I think we have earned our lunch. So I'll be failing in duty if I don't thank and compliment our colleagues from direct tax team and indirect tax team both, who worked tirelessly to make this session happen. And
yeah, let them stand up, I think.
They are all sitting in the last rows. They may please stand up. A big round of applause, please. So thank you for your continued patronage. Let's join for lunch.
Thank you so much.
Thank you so much.